York City on this Thursday, January 2nd. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills this morning. Happy New Year to you all. Let's get to the three things that you need to know today.
First up, U.S. stocks starting the year off in the green after 4 consecutive days of losses. Equities looking to stage a comeback, led by gains in technology stocks. Despite the declines heading into the end of this year, the S&P 500 saw its best 2-year run dating back to the late 1990s. Meanwhile, investors digesting the latest read on the U.S. economy with initial jobless claims. That data coming in below estimates, with claims falling to an 8-month low to close out 2024, and perhaps the latest sign of continued recovery in the labor market.
Plus, Tesla's fourth quarter deliveries due out today. Analysts surveyed by Bloomberg are estimating that the company may deliver around 510,000 vehicles in the final 3 months of the year. That would set a new quarterly record for Tesla, but the company would need to sell about 4,600 more cars to make good on its forecast for slight growth in 2024.
And law enforcement officials are looking for information and people of interest who may have participated in an attack in New Orleans. That New Year's Day attack left at least 15 people dead. President Biden said the FBI is leading the investigation to determine what happened and why, and whether there's any continued threat to public safety. The president also said law enforcement is examining if there was any link between the New Orleans attack and the explosion of a Tesla Cybertruck outside of President-elect Donald Trump's hotel in Las Vegas. The driver of that Cybertruck was killed, and 7 other people were injured after the explosion. The vehicle was filled with fuel canisters and firework mortars. The incidents in New Orleans and Vegas have thrust questions about national security and terrorism threats to the fore, but just weeks before President Trump is set to be inaugurated for his second term.
Trading futures are higher this morning, led by a rebound in tech stocks. This follows 4 straight days of losses. For more, we're going to bring in Yahoo Finance's Josh Schaefer, but take a look at the U.S. stock futures here this morning. You are seeing gains across the screen right now, led by the Nasdaq, the tech-heavy average right now, pre-market, just inside of 30 minutes until the start of trade. You're seeing that higher by about 0.7%, and perhaps that gives us at least a starting point, a jumping-off point for this conversation, Josh, in technology and how technology may have been emerging as the new defensive play from what we've heard from some analysts out there.
Yeah, Brad, I mean, this has kind of been the trade over the last month, right? There hasn't been a lot that's worked in stocks in December, but what has worked is really large cap tech, right? We've been talking a lot more about market concentration again. These big names are getting bigger, really not a lot else working for the index. Go back to a day like Monday, over 400 stocks in the S&P 500 were underperforming, declining. So it's really been kind of a broad-based decline. It's been sort of that S&P 500 versus S&P 500 equal weight story, right? The S&P 500 has actually done much better than the equal weight having its worst month against the S&P 500 in about 4 years. So we're seeing similar flows right now to start the new year that we were kind of seeing to end the year. And I think one of the key things, guys, we're going to keep watching and talking about is that 10-year, right? The 10-year now down about 10 basis points over the last week. So you're starting to see a little bit of a breather there. But while we were all away on the holiday break, that was something that was just continuously rising, right? And I think that sort of started to catch interest and will be perhaps the key thing to follow throughout this first week of trading in 2025 is, do we continue to see that 10-year take a breather? Because I think above 4.5 is where strategists start to get a little bit worried, Maddie.
And we've got the 10-year moving to the downside just a bit this morning, a little bit of weakness across the longer end of the curve as well. And I'm curious, it makes me think about the economic data. And I know that you follow this closely, Josh. Was that weakness in terms of the jobless claim coming in a little bit below estimates this morning, which is good news for employees at least? What does that tell us about that weak labor market figure from over the summer? Was that just a blip, or is there potentially more weakness to come in the labor market and this was just maybe a seasonal thing?
Yeah, I mean, I think it depends on who you ask, certainly, right? When talking to a lot of economists going into 2025, that was kind of one of my key questions is the labor market slowing from August that we talked a lot about? Is it just over? Did that just kind of disappear? And I mean, in the claims numbers, Maddie, that you've been seeing kind of on a consistent basis, layoffs are still low. So it's a reason to feel good about the labor market. And overall, that layoff number going up even if it gave you lower rates, I'm not sure that's really a welcome sign for stocks, right? If you have a lot of people getting laid off, they don't have jobs, how are they going to go out and buy things, right? That's where you start to really spiral here. So it'll be interesting to see what we get out of that jobs report. Of course, just only a week away now, that December jobs report. But for now, it seems like claims are kind of just steady as they go, and no one's going to be too concerned unless they really tick up. I mean, remember, it's a weekly number, pretty volatile, so hard to take too much out of just one claims read.
All right, Josh, thank you as always. Really appreciate you joining us. We've got some breaking news this morning. Tesla deliveries are crossing the wire. Tesla's fourth quarter deliveries coming in at 495,570. That is well below the estimate, which was around 512,000. Want to run through a couple more of the numbers, but keep in mind you've got Tesla shares down about 3.5%. We saw them moving to the upside pre-market here this morning, and then now moving to the downside. Extending that drop to around 5% right after these numbers did cross the wire. Also want to mention other models in production hit 22,727, also below the estimate of 22,790. Fourth quarter Model 3Y production also coming in below estimates, coming in at 436,718. The estimate was 481,306. Fourth quarter production, lastly here, coming in at 459,455 vehicles. That was also below the estimate, which was 505,239 vehicles here. And Brad, I know that you've been following this closely as well, but the estimate here was already below what Tesla would have had to hit in order to prove out their story of continued growth. Yeah. And then they came in even below the street's estimate here. So perhaps that's why we are seeing so much downward pressure on the stock pre-market this morning.
Yeah, you think back to the beginning of 2024, and one of the things that Elon Musk had talked about even on their earnings call to begin the year, and looking back at what would have been the fourth quarter of 2023, saying that they would get to this annualized run rate of about 2 million cars over the year. And that's where my eye naturally went towards here, is looking at that holistic 2024 number. Mm-hmm. And that print came in at 1.78, 1.79, if you want to round up, million vehicles ultimately delivered here. And the production, 1.77. So all these things considered, still below what they had put out in the street and out in the mind of investors in terms of that longer annualized run rate target here. But still a larger question, especially for the margins and the profitability, even as you're seeing 95% of the vehicles essentially being the 3 and the Y here, which really, at the same time of the synergies that they're going to talk about on the production side, where 75% of the Model Y is essentially a Model 3, going forward from here, it's a larger question of how many of those consumers decide to opt into that other models, that's the other 5% and more margin friendly to the Tesla business overall, unless you get people, of course, adding on the packages. That doesn't necessarily get factored in, at least into the kind of just back of the napkin kind of calculus that you're running here on these numbers, at least that they put out.
But it's really great that you pointed out kind of the full year here, because that was also a miss, obviously, because of their miss on the quarter. They were looking for, based on analyst estimates, 1.81 million deliveries and came in just shy of that at 1.789 for the year, as you mentioned, Brad. Yeah. So just important to look at some of those stats. Of course, we're going to continue to monitor what's going on with Tesla stock throughout the day. But again, we've got that stock moving down as much as 5% off of this news this morning. Well, moving on here, 2024 proved to be another big year for tech stocks, but as investors prepare for 2025, a big question: will the Mag 7 continue to outperform, or is it time for investors to look elsewhere? For more on this, I want to bring in Mike O'Rourke, Jones Trading Chief Market Strategist. Mike, great to have you this morning. I do want to talk to you about what we're seeing with Tesla this morning, because it's been the outperformer of the Mag 7 since the election result came out. Does the delivery story indicate to investors that they need to be looking at the fundamentals of a company like Tesla more than they look at something like a story of what's going to happen with the Trump administration?
I think so. I mean, since the election, I believe Tesla and Apple have driven more than half the Mag 7 gains and have been the key drivers of the S&P 500 gains since the election. And obviously, a lot of that, especially in the case of Tesla, is based on Elon Musk's close relationship with President Trump. And here you have a situation where the fundamental story did not play out in Q4. I know the company's profits, et cetera, peaked a couple of years ago. So again, I mean, Tesla shares, I think they were up more than 60% since the election, which is 7-8 weeks. So I think people were really caught up in enthusiasm, exuberance, and I think just in general, it's kind of taken over the market, especially the Mag 7 names. And I think it's time for people. You don't have to come out of the market, but you should be looking elsewhere for a little more, protection, a little more value cushion there.
Mike, who are the most stable Mag 7 stocks in your perspective?
I mean, so the problem with the entire group is they collectively trade about 50 times trailing earnings. So they're expensive as a group, and they're making the entire S&P 500 as an index expensive. I mean, and each one has their own different nuances that make them attractive. Obviously Amazon's in so many different places, and now you can see they're making a push into AI semiconductors, where I don't want to say they're going to compete with NVIDIA, but NVIDIA being the only story for the past 2 years is about to end as they start to see competition from the likes of Amazon and Broadcom. Obviously, then you have Google and Microsoft making their pushes in AI, but Microsoft, for its early advantage it had in the beginning of last year, seems to be dissipating. So you're seeing tides change within that group. That again, I mean, I would avoid the group entirely and look elsewhere in the market.
So where else do you look?
So if you look at, for example, I think Josh in the last segment mentioned the S&P 500 equal weight versus the S&P 500. The S&P 500 due to the Mag 7 is 30% more expensive than the equal weight. But even if you don't want to go there, if you go to the S&P 400, which is mid-cap names, that's about 50% cheaper than the S&P 500, trading about 17 times earnings. And the same thing goes for the S&P 600 small caps. So trading, paying 16, 17 times earnings for different segments of the market, you avoid that quote unquote safety of those large names that you talked about. But again, people are paying a premium for those large names, so they don't represent any type of value or protection. And there is risk if these tides continue to shift among those Mag 7 names. There's risk. So we can have a year in 2025 where the S&P 500 is flat or goes down, but the majority of stocks trade higher. That's how big the disconnect is between those names and the rest of the stock market.
How much do you believe the rest of the stock market will trade based on the FOMC and what the FOMC decides to do with rates this year, as well as their balance sheet, versus what we may hear coming out of 1600 Pennsylvania Avenue?
I think the entire market's going to be driven by 1600 Pennsylvania Avenue. I think the beginning of 2025 is going to be all about watching President Trump and how his policies unfold. And obviously there's high expectations coming in. As far as the Federal Reserve, I think we got probably an extra 50 basis points of easing in 2024 that we didn't need. The economy has been fairly strong the past couple of years, and both years the Fed came in expecting it to be much weaker. So now obviously expectations are resetting that we won't see as many rate cuts in 2025. So from a Fed perspective, the good thing is hopefully they don't do that much. Maybe it's 1 or 2 rate cuts. And that will allow investors to concentrate more on those single stocks without worrying about the Fed and without worrying about, whatever the Fed's feeling this week, because that's kind of how policy has been prescribed over the past couple of years. So from that perspective, the bigger risk is about the uncertainty with policy and how successful will President Trump be in achieving these pretty lofty goals that have been set forth during the election season.
Well, something else that's pretty lofty is the price targets for 2025, Mike. The most bullish indicating a 19% gain on the S&P 500. You said to stay out of the Mag 7. How do we get gains like that in this market without those drivers continuing to be the biggest gainers for the market moving forward this year?
No, they have to be the biggest gainers. Basically, the Mag 7 is about 35% of the S&P 500. The top 10 names are 40%. The index is very concentrated. So again, it's kind of like, it's almost the point where you're making a single bet on these handful of mega caps that are going to drive everything. And I don't think that's, from an investment perspective, if you're thinking as a long-term investor, You want to be buying things that represent value that are going to be good for the next several years, not just trying to chase a momentum game over the span of 1 year. You want to be buying things that are going to be attractive and that you can feel comfortable owning for the next several years.
Mike, thanks so much for the insights and perspective. Our first morning brief guest of 2025. Appreciate it.
Thank you.
Switching gears here, a Tesla Cybertruck explosion outside President-elect Donald Trump's Las Vegas hotel early Wednesday is being investigated as a possible act of terrorism. One person inside the truck died, and 7 others are being treated for injuries, according to the Las Vegas Police Department. An official told reporters that the Bureau believes it was an isolated incident.
Tesla CEO Elon Musk said on social media the explosion was caused by, quote, very large fireworks or a bomb carried in the bed of the rented Cybertruck and is unrelated to the vehicle itself. Also adding that law enforcement believed it was most likely intentional. In the past year, Musk has become a major donor and closer advisor to the president-elect. When asked about a possible political motivation for the attack, Las Vegas officials had this to say.
We know that Elon Musk is working with President-elect Trump, and it's the Trump Tower, so there's obviously things to be concerned about there, and that's something we continue to look at. I just want to make sure that our community understands we believe this to be an isolated incident, and it is now over as far as the danger.
President Biden said that law enforcement was investigating whether the Las Vegas blast has any possible connection with a deadly New Orleans attack that occurred just hours prior. But, quote, thus far, there's nothing to report, end quote. We'll continue to bring you updates as they come. Much more ahead on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's talk Tesla, reporting fourth quarter deliveries this morning, delivering about 495,000 cars in the final 3 months of the year, falling short of estimates. Yahoo Finance's Pras Subramanian joins us now to really get a read in further here on the numbers and a little more color on it. Pras, what do we know?
Hey, Brad. Yeah, so big whiff here for Q4, 495,000 deliveries, as you mentioned, missing estimates of 510,000. For the year, Tesla delivered 1.79 million, missing estimates again for 1.8 million, and also missing last year's total of 1.808 million, so down for the year. Tesla warned production will be impacted by its preparations for its new vehicle, but this was unexpected. A far cry from years past of 50% compound annual growth rate that Tesla had for many years. Meanwhile, China's BYD said it sold around 4.3 million cars in total in 2024. 2.5 million of those are hybrids, meaning they sold around 1.76 million pure EVs, just knocking on Tesla's door.
Praz, I am wondering if this is a sign of the post-election Tesla rally fading here a bit once the fundamentals come into play. We've seen a huge run-up post-election, but nothing really happened to change the Tesla story. Is this a sign that the fundamentals are coming back in and impacting the stock?
I mean, it's hard to say if this is going to reverse that the massive Tesla rally that it experienced at the end of last year, but it certainly doesn't help when you miss pretty badly on Q4 numbers and then report a year-over-year delivery decline. That's not good. You don't want to see that for a company with a 4P PE that's out in the stratosphere. So this is definitely not a good sign. This is the fundamental story of this company is the auto business. But let's take a look at what people are really bullish on. Robotaxis, autonomous technologies, even Optimus robot. These are the things that are going to drive the stock much higher than just your regular auto industry PE ratio, which is quite low in the low single digits. So I think, Maddie, you might be right about the fact that it's not going to help them in the near term, but it's all about those future bets that sort of drive the stock.
Yeah, I think that's a really interesting point, Praz. The idea that story, again, of some other bullishness in the market about EVs could outweigh some of these individual fundamental pieces of data that we may be getting in the meantime. Praz, thanks so much for breaking down the numbers. We appreciate it.
Thank you.
Let's dig into another trending ticker we are watching today, BYD, hitting a new monthly sales record in December, boosted by government incentives and discounts. The Chinese EV maker selling more than 500,000 cars in the final month of the year. That helped push annual sales up 41% year over year. You can see the stock moving just around the flat line here, perhaps getting a little bit of sentiment moving to the downside and sympathy move off of those Tesla deliveries. You would expect kind of the opposite because the two are competitive here. Having said that, it's really interesting looking at BYD last year, again, having over 42 million passenger cars sold. You can contrast this with some of the challenges at the likes of Nissan, obviously Stellantis having significant challenges. But I even thought this morning, Brad, about what we saw with GM closing down their robotaxi Cruise unit in competition with robotaxis. Just this idea here that you continue to see the winners and losers kind of forming themselves in the EV space, and BYD really becoming a homegrown winner, at least over in Asia.
Yeah, this speaks to one of the elements that IDC had actually called out in its study and its analysis of the electric vehicle landscape more broadly here, which is where you might see even more of the government subsidies between the entities that are beneficiaries, in this case a BYD in China, and China trying to create even more mind share and market share that gets retained by the homegrown auto manufacturers, really become a prioritization there, and how that could impact a company that we were just talking about in Tesla. That's come up in conversation, especially on earnings calls as well, at least from analysts who have peppered some of the executives with questions. And then additionally, it'll also come back to one of the major catalysts in supply chain expansion going forward from here too. How for all of the electric vehicle automakers, they're sourcing and continuing to maintain some of their longer contracts for lithium. Don't be surprised if lithium is one of those, maybe not an Oxford word of the year, but a hot button topic or key word that we hear for some of the electric vehicle earnings calls and hear from the companies over the course of this year with regard to some of the sourcing of that core component for batteries as well.
Maybe it should be, though, the word of the year. If nuclear
it's going to be hard to push.
The word of 2024, maybe if we do see so much bullishness on EVs, maybe lithium becomes that second, third derivative play and we see a lot of outperformance there. I don't know.
It's not as sexy as the mirror, so.
Exactly.
Yeah.
So how can you trade it?
Right. Also, everyone, we're going to talk a little Apple here on the day. Finally, Apple offering discounts in China ahead of the upcoming Chinese New Year. This comes as the iPhone maker faces increasing competition from Chinese smartphone maker Huawei. Now, Apple is giving customers about $68 off of the iPhone 16 Pro and the 16 Pro Max, as well as smaller discounts for other models here. Shares right now pre-market, they're lower by about 0.6%. The reason that this is such a big deal and the significance of this is because Apple is a company that does not and historically has not had a past of offering discounts, especially here in the US. And so for them to be doing it in other regions really goes to show how much they're trying to attract net new customers and retain existing ones, hoping for a super cycle of upgrades as well.
It's fascinating to see this come off the back of Huawei cutting prices for some of their higher end devices as well this week. Their mobile phones were cut by up to 3,000 yuan. That's about $411 over the weekend here leading into this week. So perhaps that is something that gave Apple the final push. I'm sure that this was already in the works prior to that, but those Huawei devices are still cheaper than the Apple mobile phones, the iPhone. And also it's that homegrown element that we've seen time and time again is so important to buyers in China. And we see that continuing to be a positive lift to not only the likes of Huawei, but also the likes of BYD. It ties into our last conversation. And we continue to see incentives not only from those Chinese companies, but also from the government there that is coming up here potentially. Some of that stimulus could also lead to more purchasing at the likes of Huawei.
The year of the snake, set to be a wild one.
It's set to be a wild one. That's exactly right, Brad. That's exactly right. We've got to get some travel here for us moving forward. All right, we're going to have all of your markets action ahead right here on Yahoo Finance, so stick around for more. You are watching Morning Brief.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
We are just seconds away from the first opening bell of 2025 here. There you're taking a look at some of the futures going into the start of today's trading activity here. Just outside of the opening cross, you've got fractional gains across the board off of 2024, where we had the Dow move higher by about 13%, the S&P 500 move higher by about 23%, and then the Nasdaq futures, or the Nasdaq Composite more broadly in 2024, you saw gains of about 29% there for the tech-heavy average. Here are our first bell ringers of 2025. The American Red Cross kicks off today's trading activity at the New York Stock Exchange and in Midtown Manhattan at the Nasdaq. You've got New Era Helium ringing the opening bell there. We've got some fresh funfetti in the air at the second floor overlooking Times Square, where you had a lot of funfetti at the ball drop, of course, that took place in Times Square to kick off 2025 as well. Well, that was a look at our opening bell ringers. Let's take a look at the major averages as we begin today's trading activity. I'll start with the Dow Jones Industrial Average. Fractional gains that we saw in the futures, that's what transpires into the opening bell. We're up by about 0.7% to begin. I'm giving you a 1-year or 52-week view just to give you some context of what exactly has taken place coming into this, the first trading session of 2025 here, where over the past year you saw a move higher by about 13.5% for the Dow Jones Industrial Average. Fractional gains to start here for the Dow, for the S&P 500, and for the Nasdaq. The Nasdaq starts the day up by about 0.5%, and then additionally the S&P 500, you're taking a look at gains there of just a little over 0.5% as well. Just quickly want to take a look at some of the sector activity to begin today's trading, and you're seeing energy lead the pack right now. Green across the screen to begin today's trade. For much more color on what is transpiring right now, plus a little bit of a look at the technicals of one key asset that a lot of people piled into in 2024. Let's get to Yahoo Finance's Jared Blickbury for a look at what is moving. Hey, Jared.
Well, thank you, Brad. Well, let's start with first, stocks are opening green in 2025. That is a good news. We're still watching the Santa Claus rally indicator, and it's an indicator. So that actually portends what the entire year is going to bring when you take the last 5 trading days of the prior year plus the first 2 of the new year, and we're in the first one right now. So 6 days total are we in. If that is positive on the 7th day, and so that would be tomorrow afternoon at 4 p.m., well, that portends a positive 2025. And this is a pretty good indicator. Right now, you're seeing it negative, so that's a little bit of a warning. I would say that at the beginning of last year, we were looking at a negative Santa Claus rally indicator, and yet we had above 20% returns in the S&P 500. So you can take that with a grain of salt, but it is the first indication that we have that there might be a few bumps in the new year. And also, let's take a look at the U.S. dollar. This is something that I think is much more instructive and relevant to the present here. I'm going to put a 3-year chart on so you can see how it has now jumped again out of a prior consolidation zone to the highest point in 2 years. And this is what's really pressuring and which has pressured equities. We saw a couple of negative 1% down days, 2 in a row to end the year, and there are some concerns over that. So the U.S. dollar index is going to be in focus this year as it potentially weighs on risk assets. We can spend a little bit of a time here on the sector action. Looks like tech and energy are still leading in the early going. XLY, that's consumer discretionary, flashing red and green right there. But I want to focus on Bitcoin. And this is what Brad was talking about just a moment ago. It's up 3%, and it is now completed. It is now bounced off of the key technical level. And let me just dial this down to a 2-month chart so you can see this a little bit better. This is what could be considered a head and shoulders top if you break the neckline right there. And that's around $90,000. That has not happened. And so it's a little bit premature to call that. And that's why you don't want to call these things too premature, because now it is bouncing up. And now that just means this is a consolidation. So it is not a top until you get below 90,000. That's where I draw the line there. But we are at 96.5 there. So looking pretty good technically in Bitcoin. Also want to spend a few moments in the futures market where we are seeing some action in WTI crude and gold. So let's see if we can find find CL equals F first. It is now jumping to the highest point in a couple of months. And here is the 2-month chart. You can see highest in 2 months. And I'll give you a 1-year chart for some more perspective. There's really not a lot of fundamental news. API came out with their weekly estimate of the DOE report. That was a little bit bullish, and so that might explain the jump. But I think it just broke out of a key technical range. So watch crude. And as I mentioned, gold was also jumping to the highest level in 2 weeks. So that's something we'll keep an eye on too. Maddie?
All right, Jared, thanks so much for breaking all of that down for us. We appreciate it. It's time now for today's strategy session. Trading officially underway for 2025. So what are some stocks to buy and sell going into the new year? Joining us now with some more insight on investor positioning in the new year, we've got JJ Kinahan, IG North America's CEO. JJ, thanks so much for making time with us this morning. I want to talk about one name in particular to tick off our conversation here, and that is Cisco. We've had some guests come on and say that that is going to become the new AI play. Oh, actually, we lost you, so we're just going to chat really quickly here. But Brad, what I was going to say is that it's been really interesting watching Cisco because it's this old school software name. It was a key kind of flagship of the .com bubble. And so then to hear investors coming on our show and saying, oh, Cisco's the new AI play heading into 2025 has been really interesting. I think we do have you, JJ. So we are going to turn back to you on Cisco. Talk to me about your bull case for this name.
Yeah, sure. Thanks, Manny. And so, this is one that I think is really interesting. We hear so much about AI, as you just got speaking about. And what I think people sometimes forget is you really need the networkers also. And so with that, Cisco is really well positioned. We've seen our clients on our Tasty Trade brokerage side really start to, over the last 3 weeks, particularly buy this stock. You see the two other stocks along with it that they have been buying significantly. Microsoft, actually not a big surprise. And the fact that it's a darling of retail, usually one of the top 3 names bought. What's the reason I talk about it, though, perhaps being a bit unusual, is the amount of buying. Usually, retail tends to be a little bit more of a buyer than a seller, like 52-48. They do trade back and forth more than people think. But more than 75% of the activity we've seen in Microsoft over the last 3 weeks has been on the bullish side. That's a very bullish sign and very unusual. And then, of course, the last one on there being Reddit. And what we've seen there is not only our clients loving it, I think there was a doubt on some people if it could compete in the social media context. They've done an incredible job overall of continuing to add users. And at the same time, you're seeing so many analysts put targets above 200 on this stock. So those 3 have really been incredibly interesting to me. Where you started with Cisco, this is one that, as we know, well-run company worldwide. As AI continues to expand, it's going to be really interesting to see how much they can continue to expand along with that. And again, I think the networking side of it is the most underrated side of what's going on in AI.
Just 2 follow-up questions on that, JJ, because
Sure,
as I'm looking at Microsoft and Reddit specifically on those, how much of the way forward from Microsoft also depends upon what allocation of that $10 billion investment into OpenAI is actually towards what's going to be a split business. There's going to be a for-profit side and a not-for-profit side that continues to operate. And then just a sub-question, since you mentioned Reddit as well, it seems like even more so than it being a social media platform, the prevailing thought is that this could also be a major AI play as some of that data gets analyzed and aggregated and then and the analyzation of that fed into other generative AI systems.
Yeah, I'll start with the second one first, Brad, because I think that's a great point overall. And it is something that people have continued to talk about. And I think one of the other things that has been incredible about Reddit is, because they have so much information, will this be a site that eventually, there's so much activity in there in terms of people talking about what's going on in the markets, as well as some of the social media aspect of it, that the AI use for the markets is going to continue to be incredible, as well as in other areas, obviously, besides the market. But that's one that I think is particularly exciting for many people. And then, as you said, with Microsoft, this is, sometimes your question is a great one in terms of a bifurcated business. But I think that sometimes we forget how big they are. And what I mean by that is they have so many other businesses going that we've seen this now over 20, 25 years, we tend to focus on one side. And if that slows down, say, oh my God, that's terrible. But they do so well on others. So I'm not quite as worried about that. I think one of the more exciting things they've done is in terms of Activision. And, that is something that we'll see how they actually monetize that. I think it's one of the most underrated things they've done over the last few years in terms of, the gaming industry. And as you say, we don't know where AI is going to take us as far as gaming necessarily. I mean, we've seen some great strides there, but what will continue there is what's going to be really interesting to me.
I want to end on a sour note, JJ. You've also got some bearish picks for us heading into 2025. Walk us through your reasons.
And so the one that's the most interesting to me, Maddie, is actually Dell. Now, Dell's not a stock that I talk very much about. I don't think you guys talk a ton about it here on the show either. And it tends to be one of those stocks that goes along, if you will. Well, what we've seen with Dell is our clients over the last few weeks have turned very bearish on this stock. And why I find that interesting in terms of just seeing what's going on there, talking to people for the reasons they're selling it, et cetera. This is one that's being played as a derivative play on perhaps tariffs in China. Really surprising to me because, as I said, this is not a stock that I think was discussed much by people in general. So I want to keep a close eye on this and keep a close eye on what's going to happen to tariffs in China if they will come through to the level we think overall. In terms of the other two that we have there, Delta Airlines just their 52-week high. As soon as they hit their 52-week high, we saw sellers coming in. The stock has gone down since then. But what's interesting to me is the selling hasn't continued. The selling has continued. I apologize. People have not taken profits on it, et cetera, back down at these levels. Some people probably took profits, obviously, at a 52-week high. But we have continued to see selling there. And then Pfizer. Pfizer has had a decent rally, nothing spectacular, but a decent rally, I'll call it, since mid-December. And our clients have used that as a very, very prevalent time to sell the stock. As I said, you're usually about 52.48 for most stocks in terms of buys or sells. And we have just seen buying for Pfizer more of like a 30% level, which I think is really, really interesting overall.
JJ Kinahan, thanks so much for taking the time here with us just after the opening.
Happy New Year, guys.
Happy New Year to you. Good to see you.
Thank you.
Maddie, on over to you.
It's time now for our chart of the day here, taking a look at stock performance within presidential cycles. Obviously, we are heading into the inauguration of President-elect Donald Trump, heading for his second term in office. So I want to take a look at stock performance within presidential cycles. And by the way, this does include the first year of a presidential cycle, even if that means that the person is coming into office for the second time. So this would apply to the Trump administration coming up here for the second time here. Stock performance in the first quarter of the first year tends to be the worst quarter for that sitting president. It's up about 0.1% of the time. So typically that's not going to be very good for the market here. Obviously, you get bigger returns in the quarters following. You can see that outperformance heading into the second quarter and the fourth quarter of those years. And then you can see more performance to the upside in the later years of a presidential cycle. So what does this mean for investors? Well, typically you do want to look at those technical factors as an indication of what the market performance could look like. But I think Jared put it really well when he was talking about the Santa Claus rally. It looks like we are on track to not get that Santa Claus rally this year. From a technicals perspective, that would indicate that we're going to have a tough January. That means we don't get the January effect, which is supposed to mean that you don't get a good year for stocks. But just look at 2024 as an indication of why that trend doesn't always come to fruition. We saw a tough Santa Claus rally. We didn't make it in 2024, and then we saw stocks up over 20% in the end of that year. So clearly, the technicals can be a signal of what you can expect for the market, but it doesn't always come to fruition. Having said that, did just want to point out that first quarter of the first year of a presidential cycle does tend to be a bit bearish, Brad.
All right, Maddie, thanks so much. Coming up, everyone, 2025 poised to be a big year for IPOs, initial public offerings. We're taking a look at the most anticipated public offerings expected this year. That's next on Morning Brief.
IPOs could gain momentum in 2025 after a quieter than expected 2024, but we did have a few bright spots in the public market last year, including the IPO of Reddit and Astera Labs. Joining us now for more, we got Phil Hazlitt, Equity Zen Chief Strategy Officer, to talk all things IPO outlooks. So, Phil, I mean, is 2025, is it finally going to be the year? That's our big question as soon as you walked into the studio.
Yeah, well, we were talking about it earlier. First off, thanks for having me, but couldn't get much slower than 2024 or even 2023. So I think particularly in the tech sector, there's a lot of companies that are eager to test the public markets. I think the big question is whether the market will receive them, right? We've talked about some big successes. Reddit's been on an absolute tear. Astera Labs, ones that you've mentioned. The question is, for these other 1,200 unicorns, particularly the tech companies, it's kind of like, am I good enough? Like, am I ready to take things public?
It's not even about the unicorns anymore. It's about who's the decacorns, who's the hectacorn on the market. Where do you think the most poised and perhaps most apt to make a public market appearance are this year? Which names kind of rise to the top?
Yeah, well, the first thing I would say is you hit the nail on the head. It's not just, I have $1 billion valuation, I'm ready to go. You have to have the absolute metrics behind it, right? ServiceTitan was doing hundreds of millions of dollars of revenue. Rubrik was doing hundreds of millions of dollars of revenue, right? So these were $5 billion, $6 billion, $7 billion businesses in valuation. So first, that's kind of the mark I'd say. I'd say one that we keep an eye on is a company named CoreWeave. CoreWeave's a tech company that does a lot of the GPU computing, right place, right time for AI and data centers. So that's one that we're keeping an eye out for. A couple other names that we do talk about that are popular have actually solved kind of the liquidity problem, not through an IPO, but through other means. And those are names like SpaceX, Stripe, and Databricks. So I'd actually argue that those names are farther away from IPO than maybe others have expected because they've solved some liquidity internally already.
So there's not as much incentive to go public then. I want to circle back on the kind of computing names and talk about Cerebras in particular, which was on your list. And there was a lot of hype around it, especially around talk of the IPO, first coming out as this potential competitor to NVIDIA. Is that going to be the case?
So great name to call out because Cerebras is kind of this dream company name because it competes with NVIDIA, so it's going to get a lot of attention from not just institutional investors, but retail investors. But Cerebras also has a challenge in the sense that its revenue is heavily concentrated, I think, amongst one customer that makes up something like 2/3 of their revenue out in Dubai. And you couple that with the fact that they had to go through some type of regulatory approval. That IPO was announced, I think, a few days after the election, and we still haven't actually seen any updated filings. And so what I suspect is that maybe this was a name that investors on the retail side were really excited about, and some institutional investors said, well, just because you put your name next to NVIDIA doesn't mean you're going to be an all-star. So there's probably just a bit more digging, but pretty exciting name to keep an eye out for.
What about the raise? How much these IPOs are expected to raise as they start to show the public markets how apt they are to actually get into the space, especially considering how it's, like you said, not just about being a unicorn company, but also showing that you've got solid profit and your fundamentals can match as well.
So IPO sizes have grown over time, and so have the baseline metrics. I would say about 10 years ago, we looked for a tech company to have maybe 100 million plus in revenue, and now we're seeing numbers closer to 300, 400, or $500 million. As far as the actual IPO sizes too, the amount raised, things are getting up close to $1 billion at this point, probably raising $300, $400, $500 million. Now, some of that might be going towards liquidity for early investors or early employees, but the sizes have certainly grown. And so we expect that to continue. And part of that is because in the private markets, you can actually raise $100, $200, $300, $400 million at a time, right? So you actually have choices here. So if you are going to go big and go public, you're probably going to do it when you're a much larger company and you want to raise more money.
I want to talk about the venues as well, because it seems like in 2026 there's going to be a new venue here in the U.S. and the Texas Stock Exchange that is backed by some major investors, BlackRock being one of them. And as we think about what that could mean for the venues that IPOs have to choose from, especially as some of their private equity market players have some influence in the conversation and that choice as well. What is that set to do for the decision of whether or not to go public now in this year versus in 2026, and some of these names potentially putting off an IPO yet another year?
Yeah, so at Equity Zen, we've predominantly seen companies end up listing at New York Stock Exchange or Nasdaq. I think that's been tradition. But there's always probably some interest about doing things differently, particularly in the tech space, right? So we saw Long-Term Stock Exchange was something that launched a few years ago. They've been a bit more active on the private side. We've seen some new potential venues in 2026. I would say it's tough to shake an incumbent, right? It's tough to shake off the two-headed monster that's been doing all of these listings. It's really just up to the companies. But what I will say is that one thing that we saw in the last few years is companies do need to address liquidity. It's one of the reasons why we exist, right, at Equities End. But we've seen companies address it in unique ways. Big tender offers, buybacks, delaying IPOs. So it wouldn't surprise me if these companies would be eager to try something that addresses liquidity a little bit differently than the de facto, IPO listing.
Sure. It's usually a lot of the institutions that have that kind of early access into the IPO pricing or even pre-IPO pricing, but that's become a little bit more retail focused now too, as investors are trying to figure out how they can get some type of early positioning as well. What are the ways that retail investors or the person that may not have as much money to throw around and make a market in a company, but wants to have some type of exposure as a company is getting ready to go public and making their debut? What are kind of the triage or at least the mindset that they should have as they're evaluating perhaps the pillars for the IPO?
Sure. It's a great, I'll start it with one stat, which is that about 10 years ago, there were almost twice as many publicly listed companies as there are now. So you've actually seen fewer and fewer companies go public, fewer and fewer available options. What that would lead you to see is that a lot of the companies that are growing are kind of in the private markets. So my recommendation would be for, typically accredited investors, that's usually the requirement to invest in these companies is, one, it's a risky asset class relative to other things. It's much more liquid. It's not a button that you can buy and sell immediately. It comes with risk, but it comes with opportunity. These were the companies that probably went public, 20 years ago would have got public at $500 million valuations, and you would have participated in the growth, kind of like an Amazon in 1997. You compare that now to an Uber that goes public at $50 or $60 billion. That growth has all been captured by private investors. So that's kind of the bet you're making as an individual is I want to add that back into my portfolio because 25 years ago it was already in there.
Interesting. Phil, great to have this conversation with you. Thanks for joining us.
Thanks for having me.
Appreciate it. Coming up, everyone, 3 risks to retailers in the new year. Yahoo Finance's Brooke DePalma joins us next with more. By most measures, the economy is in solid shape, but key risks are emerging for retailers in the new year. Here to break them down, we've got our own senior reporter, Brooke DePalma, here with us in studio. All right, Brooke, so what's up? Some cold water to start 2025?
Only January 2nd, and we're already hearing about some potential risk here. We know that it's a fairly healthy consumer heading into this new year, but one key risk is the possibility of port strikes yet again set to hit next week. If you remember back in October, everyone was worried about those bananas, but but the International Longshoremen Association and United States Maritime Alliance reached an agreement that increased their pay by roughly 60%, and then it seemed like negotiations ended. But we now know that there is one key issue remaining on the table. That was a tentative agreement that was up until January 15th. That one key issue remaining is workers seeking protection against automation. So negotiations are set to resume on January 7th, leaving roughly 8 days before that January 15th deadline, and also right ahead of Trump taking office yet again on January 20th. Now, retailers are keeping a key eye on this. In the last quarterly earnings from Target, we did hear from the CFO there saying that their team took decisive action to route select shipments to West Coast ports. This came at a cost, but allow us to be well positioned for our guests through the strike and into the holiday season. The strike was short-lived. They said they'll continue to watch until January, but that did end up hitting their earnings last quarter.
Brooke, we got about a minute left. What are those other two risks?
Two risks here include the possibility of those tariffs from Trump. We know that he plans to impose an additional 10% tariffs on imports from China. We also know the possibility of 25% tariffs on imports from Mexico as well as Canada. Of course, it's a matter of if he does that. We know that will impact mostly discount retailers, think Dollar General, Dollar Tree, as well as Five Below. In addition to that, we continue to see the third risk here, a value-oriented consumer. Now, that's good news for companies like TJ Maxx, Ross Stores, Burlington, but it is bad news for those department stores who are struggling to get consumers in, and they also want consumers to pay full price. This consumer is going to Walmart instead. They're really seeking out those value and convenience of these key players here.
All right, Brooke, thank you as always for joining us. Amazing breakdown. We appreciate you. That's going to do it for the morning brief. You can join me in the next hour for more analysis on Catalyst and catch Brad on Wealth in the 11 a.m. hour. Stay tuned for more. Welcome to Catalyst. I'm Madison Mills. Shauna Smith is out today. We are 30 minutes into the U.S. trading day. Let's get to those three catalysts that we are watching this hour. First up, we'll bring you the market outlook for 2025 and the stocks that you could buy to chase the AI trade. Plus, we'll look at risks facing retailers as a potential port strike and pending tariffs loom. And speaking of tariffs, we'll bring you the latest from Washington and what to expect under a Trump presidency in the new year. Let's take a look at some market headlines to start the hour, sponsored by Tasty Trade. Taking a look at the major averages recovering after 4 days of losses to close out 2024. You got the S&P up just about 0.2%. The Nasdaq leading gains, meaning tech, of course, continuing to lead gains as we kick off 2025. You got the Nasdaq up about 0.8%. Flipping the board over to the bond market here. I want to take a look at what we're seeing in terms of treasuries. Coming off a little bit here. You've got the 10-year down about 2 basis points here. Still above that 4.5 level, which is going to be key as a potential headwind to equities for 2025. And I also want to take a look at some of the Mag 7 stocks. It's been really interesting to monitor this question about whether the Mag 7 will still be the biggest gainer of the year as we head into 2025. This morning, seen some pressure on individual names off of company news, Tesla on those missed delivery numbers. You got Apple moving to the downside. Nvidia and Amazon, though, the gainers of the morning. And I thought this was a really important stat that I want to pull out for you. Nvidia and Amazon were the biggest profit growers of the Mag 7 for 2024, contributed the most to operating income for the year. So will they be the biggest gainers of 2025, and what will that growth story look like? Something we will continue to cover here at Yahoo Finance. And 2024 was the year of artificial intelligence, and the boom, it's not showing signs of slowing down in 2025. Joining me now on set to discuss this and more, we've got Ivana Delevska, Spear Invest founder and CIO. And Ivana, I always love speaking with you. Talk to me about NVIDIA. This is the key question. Is NVIDIA still going to be a winner in 2025? What's your bull case?
Well, Madison, thanks for having me. Basically, what we saw towards the end of last year is NVIDIA stock stalled as we were approaching the launch of their Blackwell chip. So the key for the stock from here will be how well they execute on this launch. We see significant upside once the delivery numbers ramp. We think they're going to be able to exceed $200 billion in revenue just from this product launch for this year. So we see a lot of upside. It's just going to be key to get this product rolling in the initial quarters.
What do you think was the kind of downward pressure over the past month or so? Is that something you see correcting?
Well, that is exactly it, Madison. I think it's these delivery numbers. People are still concerned whether Blackwell is showing the improvement that we are expecting to see, and whether they're able to deliver it on time, where it's doesn't have overheating issues. So those were really the challenges that the company never really said that they were facing, but we were hearing from customers. So there is a lot here in how you integrate the product. So it's not the product may be working fine, but once customers deploy it, that's the question, whether it's working good for them.
Where do valuations fall on your list of concerns and your kind of rubric for looking at a stock like NVIDIA?
So valuation is very important for us. And when you look at NVIDIA, because of the way earnings have grown, the stock actually looks very attractive on a multiple basis. So if you look at EBITDA, which is what we focus on 1 year forward, you're going to see that it's trading right in the middle or on the lower end of the historic range. And now it's cheaper than stocks like Broadcom and Marvell that we also like. So it actually screens very attractive on valuation basis.
Yeah, talk to me about your bull case for some of those other AI plays.
So basically, as we get further into the cycle, NVIDIA will remain the dominant player just because of their CUDA advantage. However, we're going to see a lot of the hyperscalers, like you mentioned, Amazon, build their own chips and bring those to market. So Marvell is partnered with Amazon. Google is partnered with Broadcom, so they're going to be helping these companies bring their own chips to market, which will take pretty significant market share over the next several years. We still, though, compared to where the market stands or what the market is assuming, we think the growth for NVIDIA will remain much stronger just because of their advantage on the software side.
And obviously, NVIDIA, the second biggest gainer year to date in 2024, but the first was Vistra, a nuclear energy play, and I know Vistra and Constellation are among your picks. Talk to me about your case for those names.
So as we saw the AI trade broaden, now we are getting into a phase where we need physical build-out of data centers and power associated with them. And the US has gone through a period of time where the power infrastructure has not really been upgraded both on the grid and the generation side. So as we've brought more renewables to market, the reliability is much lower of the grid. So what we're going to see is power prices spike up in order to incentivize new supply coming to market. So that's where companies like Vistra benefits. We also like Constellation. They operate one of the largest nuclear fleets, or the largest nuclear fleet in the US. We think nuclear is very well positioned for the hyperscalers just because of the reliability. So we see a lot of opportunity on the energy side.
How much are you thinking about the incoming administration and any regulatory looseness that we could expect for those nuclear energy names as a potential tailwind for them in 2025?
So the regulatory environment is always tricky because it does depend on states as well as the federal government. So I think less regulation would be a pretty significant positive for them. Incrementally, though, I think gas is also benefiting here from looser regulatory environment. So I think both nuclear and gas are well positioned with the new administration. I would say new administration is incrementally more positive for gas than for nuclear, which is why you've seen Vistra perform better than Constellation.
I guess taking a bit of a step back here, there's been this big question about the AI story and whether or not it is overblown, whether this is going to be the year that the investment really proves itself and we see those applications. What do you make of those questions? Do you think that those questions themselves are overblown?
I do think the questions are overblown because if you look down under the hood, we are seeing a lot of applications that we're using already today. Right. So on the search side, the new AI, the transformer model has been really transformational in terms of how we do search today. So even though those are really replacing prior search, so you're not really seeing incremental revenue from them, they're pretty big applications. Now, as we look forward, we think there is going to be a lot more innovation on the physical side of things. So the autonomy, robotics, even in quantum computing. So you're using the AI models today in order to build some of these applications for later down the road. So I think that's really like even this may be even year one, maybe year one will be next year. So it's kind of like we're really in the early innings of the applications being built out.
Do you see the AI trade broadening to some of those smaller cap companies in 2025? Because that's also been another question, is when we'll see not just the hyperscalers benefiting from AI, but also some of those smaller names.
Absolutely. So we think this is going to be the year where we see like the effect trickle down from like 2 years ago was just NVIDIA, last year was NVIDIA, some hyperscalers, some of the custom chip providers, and I think as we get further into the cycle, you'll see some of the software names on the cybersecurity side, the data infrastructure side, and then applications lastly, that would be like autonomy and robotics.
Always great having you, Ivana. Thank you so much for breaking that down for us. We appreciate it. Happy New Year as well.
Happy New Year to you as well.
Coming up, we're looking at Yahoo Finance's trending tickers page. We'll give you the news behind the moves next, right here on Catalyst. Stick around. Wall Street strategists on average expecting a slower pace of gains for the S&P 500 this year after 2 consecutive years of more than 20% gains. Yahoo Finance's Josh Schaefer joining me now with more on where Wall Street sees the market heading. And Josh, it's really interesting because I always debate this to myself in my own head, this idea of gains begetting gains, but at some point, you can't just keep going that long forever.
Yeah, you can't go up forever, right? It's sort of what I think some of the strategists were getting across in these outlooks was, okay, after 2 years of 20 plus gains, Brian Belsky called it a breather, right? He said maybe we just take a breather and markets become a little more normal this year and you get normalized returns. Well, what's a normalized return from our level? If it's about 10%-ish, give or take, it's about 6,600, which is the median call on Wall Street among the 17 strategists that we track. They're calling for the S&P 500 to finish at 6,600. Again, Maddie, still about 10% gains.
Right.
Not a bad year, but it's not the rip-roaring bull market we've seen, right? And why is that? Well, part of it's because a lot of people think we're going to see the broadening out of this stock market rally in 2025. So if it's not the largest companies just chugging higher and dragging the index up, it's going to be a little bit harder to get index level gains if you're counting on the other 493. So that's one key reason. And then you also just have an overall part of the rally at this point where a lot of the stocks have already rallied, right? We're 2 years into this bull market. Year 3 of a bull market is usually the worst year of the 5 years. So at some point, things get a little bit tired, but we're using history here. So does that actually play out? I don't know.
Right. Well, it's interesting, too, because I got some family feedback that sometimes on the show there's this mix of too much optimism and then too much pessimism. So I think some context here could be that stocks getting cheaper is not necessarily the worst thing, especially for younger investors. Maybe this is an opportunity to get in. Trees don't go to the sky, whatever. So maybe if we do see a little bit of a correction, that's a buying opportunity.
There's a lot of and there's a lot of people that are saying they would probably be buying that correction, right? Even with the Santa Claus rally over the last week that has not come to fruition, people are saying, well, have the fundamentals really changed? Do you still feel good about earnings growth at about 15% for the S&P 500 next year? Do you still feel good about the U.S. economy staying on track next year?
Right.
If you're still checking those boxes, then maybe pullbacks are viable right now until the story really changes and there seems to be more concrete concern. Right now, it's a lot of things that we're worried about would say maybe tariffs and the Trump administration, what could that do? Is inflation not going to fall? But we don't really know any of those answers yet. Just a lot more uncertainty as we enter this year than I think we had at different points.
Especially to your point, given some of those policy questions as well. But Josh, I want to talk to you about some of these trending tickers that we've got. And you can also, in our audience, scan the QR code to track the best and worst performing stocks of the session. That is on your screen. And it'll take you to the trending tickers page on Yahoo Finance. First up, let's talk about Alphabet, downgraded at JMP Securities to market perform from outperform, not impacting the stock, up over 1% in the trade. The firm citing potential antitrust penalties that could affect Google's distribution of search and search revenue in the U.S. A quote from this note, too, the analyst behind the call, Andrew Boone, saying the best case scenario would limit Google's ability to offer revenue share contracts for distribution of search. They're not bearish, though. They're just, quote, moving to the sidelines after a 37% return in 2024. So I thought that line was really interesting because they're basically saying, yes, we believe in our call that the antitrust risk could be a challenge, but also maybe we're kind of just getting to the sidelines because the stock has already rallied.
Yeah,
so
stock had a good 2024, right? It's one of the Mag 7 stocks, so it certainly makes sense when you just bring in those gains. I think what's interesting here is they're saying with the final ruling expected by August 2025. So that feels like a 2025 investor story for Alphabet for sure, and it will be interesting to see how that plays out. Interesting also that they're getting to the sidelines before we really have a clear idea, I guess, of where this is going. So perhaps they're just projecting a little bit of volatility in this name, too, as this becomes a key part of the story for 2025. They're going to have this overhang playing out. There'll be several headlines that come out. We know how these stories work, right? It's going to be something that feels like we keep talking about and keep talking about. So does that bring in a little bit more uncertainty, volatility into a big tech name, and it makes you think, all right, there's other ways to play AI. Maybe I don't want to play it with this one.
Maybe you want to own the index, for example, something we've been talking about this morning as well, instead of some of those individual names.
Sure.
We also do want to talk about Unity Software rallying as the stock gaining on social media traction. We had meme stock influencer Keith Gill, he's also known as Roaring Kitty, posting a short clip of the late musician Rick James, who once made a song called Unity, and we saw just that post alone leading to a rise in these shares of 13%, the most since November 20th. And I should mention, we obviously don't know that that's the huge reason behind the move, but it is one potential explanation this morning. And we also saw Unity rising a lot after Roaring Kitty posted Times U cover back in December, early December. So again, sort of seeing just this idea of meme stalkers like Keith Gill being able to utilize their social media platforms to, drive some of these
Keith Gill isn't out in 2025. Good for him. That's solid.
Right.
Meme stocks are still in, right? I think it's always an interesting, fun story to talk about, right? The fact that people are still so intrigued by where he's potentially placing his money. This wasn't even one of his screenshots where he's telling you that he invested in the company. Remember, we go back to part of the 2024 GameStop rally. There was screenshots of an account saying, I'm buying this stock.
Right.
And so people were chasing it then. To me, when we get out to kind of the third derivative of this, where he just tweets a GIF and you're like trying to come up with what stock it could be about. At one point, it's been a puppy meme and Chewy stock starts spiking. I don't know. I don't know when this story ever goes away. It feels like anytime he tweets, one of these speculative trades just keeps moving, no matter kind of what mood the market's in right now. Either it feels like we've been a little bit risk off for the past week now, and we've had 4 straight down days in the market. Like, it's not like we're in this crazy euphoric environment fully, where it feels like, oh, of course, meme stocks are going to go up and Bitcoin's going to rally and all of those things are happening. That's not really been the mood, but Keith Gill can flip the mood, I guess.
But having said that, we are seeing MicroStrategy moving to the upside today. Maybe there is a little bit of that risk on sentiment. Large cap tech stocks
Bitcoin's
are
up a little
upside.
bit. Okay,
Bitcoin's
all right.
up,
2025, the year of the meme.
Maybe
I'm
the
in.
froth is coming back in. We'll see. Finally, though, we want to take a look at Carvana. Hindenburg Research saying it took a short position in Carvana. That is according to the report. You can see shares still moving to the upside, actually, for Carvana, recovering a little bit from some earlier pressure here. It's interesting in this Hindenburg report. They talk about a lot of company fundamentals, some investigation into the accounting metrics for Carvana. One thing that really stood out to me, though, they actually note that the previous Carvana CEO sold $3.6 billion worth of stock between August of 2020 and August of the next year. And the year after he stopped selling, Carvana stock plunged 99% and then faced bankruptcy. So I think it's interesting when these short sellers do take a look at some of that insider selling that tends to happen as an indicator of any potential accounting fraud. And then, of course, they note a slew of investigative reporting that they have done on their side as part of this, what seems to me like hundreds of pages of this report.
Yeah, always a long report from Hindenburg, right? But you usually see more of a stock drop.
Yeah.
I was pretty interested, so I was watching it right as it came out. Carvana shares fell about 3%, 3.5%. Normally, that red line just starts extrapolating pretty rapidly downward until people fully read the report when Hindenburg comes out with one of these shorts. Didn't quite happen. Just kind of bounced right back up. I was talking to our friend Jared Blickery, our markets reporter. He said the technicals on the Carvana stock looked pretty good. He said it just held a key line. So that was sort of an interesting part of this trade. When you zoom out on this chart, the stock has just ripped off the bottom. You mentioned that this was a company that people were talking about going into bankruptcy about 2 years ago. Stock was less than $10, and now it's over a $200 stock. And so that's been just kind of a crazy ride for investors, and you wonder what this short report can maybe stir up. They're talking about insider selling after a 240% year. Are they saying they're worried about more insider selling? Definitely some overall questions that Hindenburg always leaves on the table here for someone to potentially maybe ask management the next time an earnings call comes around.
That's a really great point. Also, just the accusation that the numbers are juiced, and that's why they've had such a significant rally. Kind of mirrors a similar report on SMCI, but even that company, those shares up 600% over the last 2 years, despite some of those accusations on accounting. So it's interesting to see kind of how these short reports do tend to mirror and combat some of the company fundamentals. Josh, thanks for joining me. Appreciate it. Thanks for being on. All right, we're going to have all your markets action ahead right here on Yahoo Finance. So stick around for more. You're watching Catalysts. House lawmakers will vote on Friday on whether to re-elect Speaker Mike Johnson. And though President-elect Trump has thrown his support behind the incumbent, it's far from a certain victory. Here to discuss, we got our very own political columnist, Rick Newman. Rick, always a joy to speak with you. So talk me through what your anticipation is of this vote. I know we still have some Republican lawmakers that are holdouts for Johnson. How hard does that make his path to victory?
Well, he can only afford to lose one vote, and it looks like he is going to lose one vote. So the way this works is all the Democrats are going to vote for their own leader, Hakeem Jeffries. So Mike Johnson's not going to get any Democratic votes, and the margin is so thin that if he loses more than one Republican vote, he cannot get reelected. So he has to get every Republican vote he can afford to lose one. And there's one representative from Kentucky, Tom Massey, says he's not going to vote for Johnson. So there are some others who don't like Johnson. The question is whether they're going to come together for the sake of the party and get this done. I think we don't really know. I mean, it's entirely possible for all the preliminary drama that he does get reelected as Speaker and business moves on. But if he does not, we've got problems. So just to remind everybody, back in 2023, it was 22 days from the time Republicans ousted Kevin McCarthy as Speaker and settled on Mike Johnson. If it goes that long this time, guess what? That puts us past January 20th. Which is Inauguration Day, and Congress probably cannot certify the 2024 election if the House is not in session, and there has to be a Speaker for the House to be in session. So the craziest scenario here is that this remains at an impasse all the way to Inauguration Day, January 20. And just for kicks, I mean, fun trivia, if the Congress cannot certify Trump as a new president, Charles Grassley, who is the Speaker pro tem of the Senate, would become the president for the temporary president, I guess, the interim president. Chuck Grassley's 91 years old, so that would be quite an interesting scenario.
Rick, that would be quite an interesting scenario. I know you're not a future reader, but how likely do you think that is, given that we know Trump would obviously dial up the pushback even more than he already has to get lawmakers to vote for Johnson if that were to be a risk?
I mean, the interesting dynamic here is that Trump can tell most Republicans what to do, but not all Republicans in the House. We saw this with the vote on the temporary spending bill at the end of last year. There were 38 Republicans who did not vote for a bill that Trump wanted them to vote for. He put on social media, I want all Republicans to vote for this bill, and there were 38 who did not. Now, the margin is not going to be that big if Johnson loses. But there are certainly a handful of Republicans who are going to do whatever they want. They're not going to be influenced by Trump on this vote. So we'll see what happens. I mean, I think everybody would prefer that come Monday, Johnson is Speaker, and we just get on with a lot of agenda items. Congress has a lot to do in 2025. But we could start the year and the next Trump administration with another Republican fiasco.
All right, Rick Newman, thank you as always. Appreciate it.
Thank you, Manny.
House Republicans will hold one of the narrowest House majorities in history for that upcoming term, meaning every single vote counts. Early signs of infighting among party members threaten not only Friday's Speaker vote, but the path forward for President-elect Trump's agenda. Here to discuss this and more, Wendy Schiller, professor of political science at Brown University. Wendy, it's great to speak with you. We were just speaking about some of the infighting regarding the House Speaker vote coming up tomorrow here. If Republicans can't even elect a Speaker, can we expect that they can effectively pass policy, or is this infighting specific to Mike Johnson?
Well, that's a really important question for things like shutting the government down again or not in March, and of course the debt ceiling. And we know the debt limit will be breached sometime before the summer. So, and of course the Trump tax cut. So these are all things that have to be passed by the House constitutionally. So this is the real crux of the issue, is so much of the financial infrastructure of the federal government has to originate or pass the House before it can even be touched by the Senate. So when you think about that, the stakes are very high. If you're a strategic Republican and you're looking ahead to the future, whether it's 2026 or beyond, your time of leverage is now. What you want to extract from the Speaker is now. So if they all band together and they barely squeak by and elect Johnson, that diminishes some of their leverage going forward and looking ahead at these other issues, particularly the national debt and the deficit. So to me, if you want to get a promise from Mike Johnson, you have to get it in the next 24 hours if you're one of these Republicans that's still holding out.
And since you mentioned the deficit, the same people opposing Mike Johnson also profess to be against increasing the deficit and debt of the United States here. How limited is the ability of the House to execute on any tax cuts given those deficit concerns?
Well, Madison, this is the real coalitional challenge for anybody who becomes speaker, and certainly for Donald Trump. Donald Trump wanted to waive the debt ceiling till after the 26 midterms, and the deficit hawks in the Republican Party in the House said a firm no to that. So they don't want to give a blank check, and they were demanding pretty significant cuts to the federal budget in return for the Trump tax cuts. You know, and Trump's seeking victories. This is his second term. Constitutionally, he is prohibited from running again. Unless that changes, he's going to want some victories, and he's going to go out to the voters and really try to put pressure on the Republicans. But some of these Republicans have, objected to things that Trump wants in the past and still gotten elected relatively easily in 2024. So this just shows you the disconnect that comes with separate elections for the president and the House, because even with the same party, the constituency support is quite different on key issues like deficit spending.
It's such a great point, Wendy, too, and I hope that the investors and hedge fund managers who come on our show are listening to you right now, because so many of them say that part of their bullishness for 2025 is based on a firm belief in those corporate tax cuts coming in. What is your message to them on the likelihood of that?
Well, they've got to do some retail lobbying, and they're very good at this. But the idea that Trump can do it through Truth Social, or X, formerly known as Twitter, or get Elon Musk to go out and sell it to people, that's not going to work with people who are already looking at 2026. They know their constituents. They've been reelected, like Chip Roy, very comfortably, even in opposition to Trump. You know, the politics of the House stay fairly similar for any president, and this is why most presidents don't love Congress, sort of get in the way of things. Pay attention to what those members need in other federal spending, because that's the log rolling that will have to happen to have any Trump tax cut bill or even a safe debt ceiling approval later this spring.
Wendy, I want to talk specifically about state and local tax SALT as well. Stephen Moore, one of Trump's economic advisors, recently saying that Trump's economic team is considering doubling the state and local tax deduction from $10,000 to $20,000. And there has been a little bit of bipartisan support for that for some of the big blue states, California, New York. Does that make that more likely?
Well, I think the prospect for that was a little bit better with the composition of the bipartisan caucus on SALT deduction last session. The Republicans lost a couple of key seats in California and New York, so they're down a few in terms of Republicans who really care about this issue. And I'm not sure that the Republicans who are lobbying for the SALT cap will take just a $10,000 increase. I mean, it just seems really small given the kinds of numbers that a lot of their constituents are facing with taxes and mortgages and high housing prices. So given the housing market, it just seems like a waste of time to lobby for a $10,000 increase in it when you might be able to get a lot more given the very slim majority in the House right now. So in that sense, they're going to have to make a bolder argument and really rely on this very slim majority, even though in their own caucus, they've lost a few key Republican people. And by the way, the people who are leading the charge are also running for governor from New Jersey, two of them against each other from the House. So they're going to be pretty busy with that campaign. So I'm just looking to see where the leadership is going to come from in the 119th Congress to really make the charge to get that SALT cap much higher than it is now.
Given some of those elections that you mentioned, then, is the will of constituents and the desire and kind of support of some of these tax cut policies potentially going to move the needle on this legislation?
It really will come down to, I think, in some ways, the Republicans from California and Republicans from New York. I mean, Gottheimer and Sherrill are both from New Jersey, and they're both running for governor, as I just said. So it's really going to take some strong advocacy, and they're going to, again, have to log roll not only within the tax cut debate, but also on things like debt ceiling or the speaker's vote. They're going to have to really muscle their way in and say, we need this as a victory to sustain the House majority in 26. Because if we don't deliver this, then some of our constituents may vote in a close race for our competitor and give Democrats the majority in the House. So that's the argument California and New York Democrats and Republicans will have to make, but particularly Republicans with this very slim, difficult to govern majority that the House is facing now.
Wendy, I want to end on someone who has not been elected by the American people, and that is Elon Musk. I just want to get your take. What are you thinking about his kind of being in the realm of political power, but not necessarily having the ability to actually do anything? How effective, air quotes there, do you think that he is going to be?
Well, the key thing here is that DOGE, which people are referring to as a department, has not been created or authorized by Congress. It has no legal authority. So anything that he proposes in terms of cutting the government budget has to come most likely through executive order from the president. And the federal government is big and thick and hard to cut. So his patience level is what I'm watching, both Trump's patience level with the amount of publicity that Musk is getting. The Democrats are calling him co-president or President Musk, which is irritating Trump. But the second thing is, how much patience will Elon Musk have for the vast morass that is the federal government? How long will he really want to stick around? So that dynamic, I think, remains to be seen. But at the moment, he doesn't have any legal authority. And you can already see from the Republicans that opposed the Musk plan for the budget, 2 weeks ago, they said no. And I think they are going to try to assert as much of their power vis-a-vis Musk as they can.
Right. One head, one crown. Wendy, thank you so much for joining us this morning. Really appreciate it.
My pleasure.
Coming up, with Trump set to take the White House, why one founder predicts the next 4 years will benefit not just Elon Musk, but the entire space economy and how you can invest. That's next.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Elon Musk is gearing up for a busy 2025, not just due to his ally President Trump taking the White House, but because of his work at SpaceX, which is asking the FAA for approval for up to 25 Starship launches this year. Musk isn't the only founder looking to the stars this year. Joining us now with his top predictions for the space economy in 2025, we've got Chad Anderson, Space Capital founder and managing partner. Chad, great to have you in studio as always. So Elon Musk, obviously increasing his power, increasing his wealth, given the rally we've seen in Tesla stock. Does the kind of story around Musk, I almost just said Trump, increase your bullishness on SpaceX for 2025?
Absolutely. Okay, so to put 2025 into context, it's helpful to think about 2024, which was a massive year, really underpinned by a lot of milestones that SpaceX set. So there was a record number of global launches. SpaceX accounted for half of those. There was this really sort of massive turning point where Boeing, the incumbent, bungled NASA delivery of astronauts to the space station and couldn't bring them back. And SpaceX has been tapped to go and rescue them. Yeah. And SpaceX launched and caught with these massive chopsticks, which I'm sure a lot of people have seen, this next generation rocket, which is going to usher in this new wave of the space economy. And so, and on top of that, $26 billion invested last year, which is up 30% from the year before. So 2025 looks like it's going to be even better, bigger and better. And a lot of this is underpinned, again, by SpaceX. So this new administration is coming in. We expect to see a lot more focus on leveraging commercial capabilities in space. And I think SpaceX is most likely to benefit here. And that's not just because he's first buddy, but also because they have the market-leading solution. If you want to launch something, if you need connectivity in remote areas, in conflict zones, if you want resilient GPS, if you want to understand where things are in orbit, like SpaceX has become the de facto, like they are the apex player in this market. And so I think they're going to benefit most greatly in 2025, but I also am optimistic because I'm seeing new companies emerge and we're going to see more competition in 2025 as well.
Well, let's talk about that because we were talking earlier about the IPO outlook for 2025, and our guest was saying that SpaceX really has the liquidity they don't need to IPO this year. What IPOs are you anticipating, and do you think we will get a SpaceX IPO at some point?
Yeah, and that's so interesting, right? Because the $26 billion that I mentioned last year, that is no capital to SpaceX. They have not tapped the capital markets in 2 years because they're basically printing money. This company is not just in the commercial realm, but also on the defense side of things. The company is generating a lot of cash flow, and it's been widely reported that they're now buying back shares, right? So over the last couple of years, they're no longer raising capital. They're funding their growth with revenue and actually buying back shares. So if you think about where SpaceX goes from here, they have big, lofty ambitions that don't necessarily align with public market expectations, right? Their primary goal is to go to Mars and take humans to Mars to settle there, right? They have aspects of their business like Starlink and the satellite communications business that is generating a significant amount of revenue and is actually could be a public company spinoff. We'll have to see if that happens or not. I mean, that's fueling a lot of their larger vision. So, do they keep that as part of the company or do they spin that off? I think that's yet to be seen. We've heard public announcements from the company have given us mixed messages, so we're not quite sure what to expect there.
So how can retail investors play the space? Is it a matter of waiting on an IPO like SpaceX, or is there a different IPO opportunity or a private credit opportunity?
There will be many IPO opportunities. So we have seen so again, a little context here is helpful. So we've been operating in space for decades, but it's really only become a category for investment and entrepreneurship over the last 15 years or so on the heels of SpaceX. So it's relatively new. It takes time for these companies to raise venture capital and to go out and to mature to the stage where they're ready for the public markets. We've not seen that yet. We've seen some companies go public via SPAC. Most of that's washed out. There have been a handful of really great companies that came from that retail investors can participate in. Rocket Lab being an interesting example. Right. Planet Labs, both portfolio companies of ours. I do think that in 2025, we're starting to get into the place where a lot of these companies have grown and matured the more traditional way, and we're going to start to see some more traditional IPOs and more opportunities for retail investors to get involved.
And I know you've got some other predictions that you sent over to us. What else are you anticipating for 2025?
Well, it's a few things, and one is China is becoming a bigger player here. They have launched a lot of rocket launches, but not a lot of payload satellites mass to orbit. That's going to change next year. They are, SpaceX has 7,500 Starlink satellites. China, they're racing to get 15,000 up. China has multiple mega constellations like this. Amazon is launching a satellite communications constellation. So if you look at the chart of satellites in orbit, it's basically a straight line up right now. That's the growth that we're talking about, is the number of satellites in orbit is accelerating faster than Moore's law, which is really something interesting to get your head around, right? So understanding where all these satellites are, how to navigate this, like it is no longer optional for us to coordinate activities in orbit. We need to get much smarter about that. We're going to see some of that play out.
And real quick, is Amazon going to be a formidable competitor to Starlink in 2025?
I think it's particularly interesting. If they can do, so they've been very tight-lipped, but if they can do what they claim that they can do with these satellites, they're going to be very capable. And given geopolitical considerations, given Musk's ties to the president-elect, I think that there are going to be some countries and some geographies that are more interested in a different solution. And so I think we're going to see some of that play out as they start to come online next year as well.
Perhaps their competitive advantage is not being Elon Musk then, heading into 2025. Chad, thank you so much as always. Really appreciate you joining us. Thank you. Coming up, we are taking a look at the biggest trends in retail for 2025. That is next right here on Catalyst. Stick around. Retailers are heading into 2025 fresh off a solid holiday spending season. Visa analysis found retail spend grew 4.8% year over year during the holidays, with consumers maintaining strong spending despite fewer days between Thanksgiving and Christmas. So what will the new year bring for retailers? Joining me now, we've got Dana Telsey Advisory Group CEO and Chief Research Officer. Dana, amazing to have you on. Thank you for being here. It's interesting. We've got this story of the bifurcated consumer, the confusing macro backdrop, but then we have the strong holiday spend. Is retail as a basket still a buy heading into 2025?
First of all, Happy New Year and thank you for having me. Yes, I think certain retailers are still a buy heading into 2025. When you think about the holiday sales results, as you just called out, Visa's 4.8%, you look at MasterCard's 3.8%, and a lot of retailers are going to be reporting their sales results on Monday, January 13th. The compressed holiday season gave a sense of urgency. The level of promotions wasn't too extensive. It was pretty much in line with plan, and inventory levels are clean. You look into 2025, and you still have a lot of uncertainty out there, but retailers are very agile. They know how to move, and I think 2025 is the year of the letter S. I think it's going to be filled with social, given that retailers and brands are now advertising and marketing more on social media channels, and social also for brand building for mission and purpose. I think it's led by the S of supply chain with tariffs, and that uncertainty is still there, but certainly supply chain and the ability to diversify takes time and costs money. I think it comes from service, given that service, whether it's service and sales associates in stores, but also service means being in stock and fulfilling and having fulfillment pretty easily and having processes that move quickly. But overall, it's going to be a year of another letter S, surprise. We don't know what it'll be, but we know that each of the past few years we've had big surprises. So social, service, supply chain, and surprise are what I think the year will be made up of. And I think you could have some winners there, whether it's companies like Warby Parker, who is seeing their traffic increase, who's expanding their reach, whether it's companies like Abercrombie, who still has the Hollister chain that can accelerate, whether it continues to be value, like what you see out of Walmart, and also what you see out of companies like the off-pricers of Burlington and TJX, that there's still opportunity for these companies that have a competitive moat to scale.
And every single one of your picks, by the way, moving to the upside in the trade today. I do want to talk about Walmart in particular, because this is one of those names that continues to do well despite the macro backdrop, can sometimes be a beneficiary of recessionary headwinds for the broader market. What do you anticipate Walmart's growth story looking like for 2025?
I mean, you think about Walmart and you think about, yes, they have the physical stores, but they also have other channels of diversification, whether it's international or whether it's what they're doing with all their other lines of business that are becoming more additive with their other revenue streams to their total business. I think what they're seeing in terms of the growth coming from some more of their higher income consumers, they're continuing to gain share.
Is it a high income consumers market right now? I mean, you mentioned a company like Abercrombie, for example. You've also got TJ Maxx on your list. I don't think of those as high income consumer driven companies. And then you've got the likes of Dollar Tree, Dollar General continuing to struggle. What does that mix of retail performance tell us about the health of this economy and the consumer?
Keep in mind, when you look at the uber wealthy, the Brunello Cucinellis and the Hermes with luxury, those are still doing fine. The aspirational customers are not spending like they had been because the elevated costs of daily living expenses are higher. If we have a continuation of lower rates, that should help us over time, should also help the housing cycle too. When you look at the dollar stores versus others, you're seeing off-pricers and discounters taking share from some of the dollar stores. And let's not forget, what will pricing look like if increased tariffs come on goods coming from China? That will be a headwind that many retailers and brands will face going forward in 2025. And that's why we like companies like a Bath & Body Works, who generates 85% of their goods and manufactures 85% of their goods here in North America.
Let's talk more about that, Dana. Obviously a huge risk for retailers lying in that potential tariff policy. What are you looking at to suss out the potential winners and losers from individual names off the back of that policy?
when you think of that policy, and we've done a whole list of companies and what they manufacture coming from China, we've seen everyone reduce their exposure to China over the past few years pretty dramatically. You still have companies like Steve Madden, where it's a work in process, and overall footwear companies have more exposure to China than others, except for one being Birkenstock, where their goods come from Germany and also Portugal for the cork, so they don't have as much exposure as compared to others. But you wade through it and you still see many companies who have the opportunity to navigate these headwinds. And that's why agility and being able to navigate the surprises is top of mind for 2025.
How concerned are you about port strikes coming back?
Very concerned, and we've watched the elements of inventory levels and bringing goods, how goods are coming in very carefully. We've certainly seen many retailers navigate exactly how they're bringing in goods and the different mediums out there, but we're watching it. It certainly was shorter than expected just earlier a couple months ago, but certainly coming up, something to be mindful of.
All right, Dana, thank you so much for joining us. Really appreciate you making the time for us this morning. Thank you.
Thank you for having me.
Let's get a check on the markets to round out the hour here. I want to take a look at shares of Constellation Energy. The company announced a $1 billion power deal with the U.S. government here, and you can see a huge pop in the shares, up over 7%. As a reminder, Constellation was among the top 10 performers in the S&P 500 for 2024. We're also getting a pop in Vistra Energy, perhaps a little bit of a sympathy move. That is another nuclear energy play in the space, of course, and that was the top performer in the S&P 500 for the year 2024. And I just want to point out a couple more details for this Constellation deal with the government. They're getting $172 million from U.S. for energy purposes and about $840 million to sell power. And it's also interesting to point out that this $1 billion power deal, again, coming off the back of a banner year for Constellation after they became one of the biggest utility names to top the S&P 500. And by the way, that hasn't happened, a top utility name for the S&P 500 since the year 2001. So again, not only a huge move to the upside as it is a second derivative AI play, but also we have government spending fueling potentially more gains for Constellation. Again, you've got that stock up over 7% in the trade right now off the back of this $1 billion funding news from the government. Taking a look at the major averages, you're still moving to the upside. You've got the Dow moving to the upside. The S&P is up about 0.2%. You've got the Nasdaq up about 0.4%. Really seeing the tech-heavy large cap names leading the trade today in the first trading day of the year, that we were still on track to miss out on that Santa Claus rally. But that's okay. We've seen that before in 2024, and we still had a year of gains in the market over 20%. All right, stick around for more news. We've got wealth coming up dedicated to all your personal finance needs. Brad Smith is going to have you for the next hour, so keep it here for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we're kicking off the first trading day of 2025 with a look at how to prep your portfolio for the new year. And AI is coming. The transformational technology could have big implications for companies who put it to work, and we'll drill down into what it means for workers later this hour. Plus, it may be a new year, but you can still make retirement contributions for 2024. We've got the details on that coming up. First, let's take a look at some of the market action as we always do. We're 90 minutes into the trading day. Stocks rising on the first trading day of 2025. Joining me now, we've got Brian Mulberry, who is the Zacks Investment Management Client Portfolio Manager. Great to have you here with us, and Happy New Year to you, Brian. You say 2025 is going to be a, quote, normal year for the market. So what does normal mean in your purview?
Well, kind of going back to returns on the market in line with earnings growth. What we've seen over the last 2 years is the S&P 500 up more than 20%. So you're roughly 45% growth over the last 2 years. That's happened only just a few times in history. Most recently, about 30 years ago. It doesn't tend to grow at 20% a clip every year. And so what we have is a lot of the price action already built in to the level of the market where we are just under 6,000 on the S&P 500. So what that means is, while we expect a good year for earnings growth up around 14%, we only expect muted returns, maybe an 8 to 10% positive year, which is certainly not bad. It keeps the momentum going. We're talking about all good things. It's just difficult sometimes for investors because they get lulled into that false sense of security. I'm going to get 20 to 25% every year out of the S&P 500. That is the anomaly. What we do expect is more of an 8 to 10% type of year, which we would simply call normal. And that might be a little bit boring, but it still means good news for markets.
Yeah, Brian, what's the earnings growth profile that you would be looking for in that instance? Because as I was taking a look at some FactSet data before we went to air, S&P 500 calendar year 2025 earnings preview that they put out saying that their analysts are expecting earnings growth of 15%. What could that earnings growth look like in your best estimation, and how does that kind of flow through to the market performance?
Yeah, so what we see is the top end of earnings growth in the S&P 500 at roughly $280 per share by the end of this year. That would be in line with that 14 to 15% growth rate that you're talking about. The problem is about 70% of that growth is coming from the Magnificent Seven stocks. And so to have such a concentration of earnings growth from so few names is something just simply to be aware of. The good news is the Magnificent Seven stocks are very profitable companies with wide moats and very strong cash positions. Those are all good things. But what it means is the contribution of growth coming from so few names is there's a risk to any disappointment, just like what we're seeing with Tesla today. Any type of disruption in that momentum is going to have an outsized impact in terms of volatility. So what we could see while we have more of a normal return structure is probably higher volatility in 2025 because the concentration in earnings is coming from so few names. So put it a different way, if we take out the Magnificent Seven from that earnings projection, earnings growth goes down to roughly 4, 5, or 6% in the S&P rather than the 14 or 15% that you get by including them.
Which sectors do you think present the largest opportunity then?
Well, some that are a little bit, I think, out of favor. Obviously, technology, AI momentum is real. There's going to be a lot of excitement there. So looking outside of that particular sector, looking at financials, what we see is an opportunity for perhaps deregulation, inviting more activity in terms of mergers, acquisitions, and IPOs, things that we simply haven't seen much of over the last 2 to 3 years. We also believe staples could be a great way to be a little bit more defensive. It's a little boring, but we're seeing very high quality structures in terms of growth from Walmart and Home Depot, places where you can kind of hide out in some of these more volatile quarters in the next probably 2 to 3 quarters that we're expecting. And then durables. We're talking about investments in growing the power grid. We think there's also going to be other infrastructure investments in terms of roads and bridges and other infrastructure spending deals, both public and private. And so there's going to be areas there where you can find very high quality companies, very strong, durable earnings growth structures, and a way to investor portfolio that's going to be a little bit defensive because, again, we do expect some volatility over the next couple of quarters until we get a stronger footing for that growth to kick in the back half of this year.
So where does the Fed play into all of this as well? What would you need to see them follow through on in order for all of the calculus that you've been lining up to really hold true?
Yeah, so they're in a tough spot right now. The market is going to want to answer the question, are we still in an easing cycle or not? And what we got from the December meeting was a bit of a mixed message. We did get a rate cut. However, there was some dissension in the ranks, not voting members, but there were definitely members of the FOMC that were saying, hey, we probably should pause at some point in the near future because we are seeing an uptrend in the near term in terms of inflation data. If you were to annualize the last 3 months of core pricing, we're back well above 3%. Now, again, it's not horrible. We're well off the highs of inflation in terms of where we came into 2024. Coming into 2025, we're just simply on an uptrend. That's going to make the Fed's job very difficult to say, should we continue to ease rates from this point going forward? So our view is maybe once or twice, roughly getting the policy rate down to about 4%. And that's about as much movement lower that you can price in at this moment, given that inflation is starting to rear its head back up. So it's not horrible. 4% is not a terrible number. It's just simply more restrictive than what the market would like. And you're going to have to price that into your earning structures, that there's a real cost of capital. So in other words, if you're financing growth through borrowing, there's going to be more of a hit to your bottom line. If you're already in a strong cash position and can organically grow earnings, those are the types of balance sheets that we're really looking for at this moment.
Brian, just lastly, while we have you, of course, the major event taking place here in January that is going to have some type of effect over the course of not just this month, but for the next few years here, the inauguration. So as you think about that and having a White House and President-elect Trump that is using the stock market as a barometer for success, what type of implications does that carry for the stock market as a whole?
Well, certainly a lot of energy built into the market right after the election. We've had a little bit of a pullback in some of that over the last week or so, but the market is definitely in a pro-growth mood, expecting pro-growth policies to come from the new administration. What does that look like? It looks like less regulation on businesses, more impetus on lending from the private sector rather than government spending, and trying to privatize some of the growth that's coming through in the GDP numbers. So definitely a lot of positive energy coming from this. But really, remember, campaign promises are not policies. We need the policies to actually be enacted, and that's where we're going to have an important day tomorrow in electing a speaker to try and coalesce around this energy and get some of those policies enacted. There could be, again, some volatility if those things don't line up the way the market has currently expected them to.
Really interesting. Brian, great to see you. Happy New Year. Thanks so much for taking the time.
Thank you.
The U.S. economy avoided a recession in 2024 as the Fed leveraged elevated interest rates to nudge inflation lower while the economy remains surprisingly strong entering into 2025 for consumers. The terrain is uneven when looking across the economic landscape. And here to discuss this plus more, we've got Jefferies chief U.S. economist Thomas Simons here with us. Thomas, great to see you and Happy New Year to you as well here. Just as we're thinking about the state of the economy coming out of 2024 and now as we kick off 2025, what are the core pillars to any type of strength that we would expect to see in 2025's economy?
Yeah, and Happy New Year to you as well, Brad. Thank you very much for having me. 2025 is a much debated topic these days, and just sitting listening through the prior piece, thinking about all these internal conversations we've had at Jefferies trying to suss this stuff out, right? A big thing right now seems to be kind of trying to determine if the net effect of Trump's policies are actually good, bad, or sort of in between, right? And a lot of it comes from trying to interpret campaign language as a fundamental expression of some sort of policy, and then thinking about how long is it going to take to put into place, when is the effect on the economy, et cetera, right? So for instance, deregulation could, in theory, happen very quickly, but I don't know that anyone has a great sense of exactly how much current regulation is really holding things back, right? So I think it's nice to think that maybe lower taxes and lower regulatory burden, especially on very small businesses, could quickly turn into economic growth in the second half of the year. But as of right now, it's a lot of wish casting and kind of like a best case scenario type modeling, I suppose.
And so one of the things that you're modeling for is this K-shaped economy. Just describe what that is, and then ultimately what that means for individuals, portfolios, their wealth management that they're trying to kind of best get ahead of, or at least predict for the best extent that we can.
Yeah, I mean, it's a tricky situation because when we look at economic data, it's generally very top-down and mostly just at big aggregate levels, right? So you look at something like personal income having risen very significantly, and it's easy to kind of look past the fact that the income for the bottom end of the distribution, I mean, I suppose wage growth has actually been reasonably good, but that's just a percentage base off of a lower level, and those people don't enjoy the asset appreciation that wealthier folks do as well, right? So, I mean, if you're in a position where you're trying to invest savings that you have, keep doing what's working, I think, right? It's one of the nicest things about the U.S. is this very sort of democratic access to markets, but it's the K-shaped economy issue, it doesn't really affect the overall growth rate that much. The sort of weakness hasn't gone, I guess you could think of it as like the fulcrum of the K hasn't risen so high that we're now seeing more weakness, but rather it does put a large number of individuals in a very vulnerable position that may lead to political outcomes in the future perhaps that cause more volatility. But for 2025 and 2026, I wouldn't necessarily think it's going to have a huge impact just yet.
Interesting. And so what does that ultimately hold for the Fed and their decision making too? Because as you mentioned, they're looking across all income cohorts. They're looking at how businesses as well are navigating what could be looked at as any type of economic turbulence so that they can best get ahead for the lagging data that they're evaluating, best get ahead of what could transpire in the months ahead.
Yeah, I mean, this is always the most difficult part of the cycle for the Fed. It's actually a part of the cycle they don't often find themselves engaged with for very long, right? I mean, usually when the economy is sort of rolling one way or the other, that transition point is relatively brief and it requires, more often than not in history, a relatively big policy change, right? Instead, I think, with apologies to Winston Churchill, we're kind of, nearer the end of or beginning of the end rather than the end of the beginning of this easing cycle. So I still think that it's more likely than not they're going to go at least 2 times, if not 3. It could be even more, but the tone right now feels like it's perhaps one that they should be approaching with a little bit more caution, right? So I think there's the other aspect that makes it difficult is, and you can hear this from some of the regional bank presidents, is that the economy is very, I would say, heterogeneous right now, right? We're more or less used to sort of everything going up or going down since the financial crisis. And I think now when you have pockets of weakness, like in manufacturing versus strong higher-end consumer spending, then the regional bank presidents whose district are experiencing more weakness are going to feel like the economy needs more help versus the others, right? And same thing with how inflation impacts those businesses as well.
Tangential but related, the weekly jobless claims came in today for the week ending December 28th, and it was lower than the anticipated figure here. 211,000 initial claims filed here. That was actually a decrease of about 9,000 versus the prior week's report. Ultimately, as you kind of look at the trend and assess the trend that we're getting in jobless claims, it continues to kind of show that there is still strength right now in the labor market. Where do you anticipate that we'll continue to see some of that strength play out, either on a sector basis or even on a wage basis, perhaps, which is more critical for the households that we're looking across and seeing where the strength of the consumer might prevail?
Sure, yeah, no, absolutely. I think, a mentor of mine in the past always cautioned me, don't try to predict employment with an unemployment statistic, right? So especially now, it seems like there's this relatively wide divide between demand for labor, which we can see in job openings and things like that, or a slower pace of hiring in sectors outside of healthcare and education and whatnot, versus the layoff rate in the JOLTS data or claims, which show that there haven't been large swaths of people kind of being indiscriminately laid off, right? That data also fails to capture the kind of the decline in the work week that we've seen in the last couple of months as well. It shows, I think, that businesses are very cautious about letting people go and thus not having access to them when things turn around. That may change. We now are through the election. We're through presumably the biggest sort of point of uncertainty for the next year or two. And as I kind of hinted at before, I think that the area to watch is one that economic data, unfortunately, doesn't do a great job of capturing, but is very small startups and mom and pop businesses and that sort of thing. Small businesses, I'm talking like less than 50 employees, have generally been the major engine of job growth, the easiest access for people building wealth through owning those businesses. And we've had a really pretty tough time for those businesses in the last couple of years. Obviously you had COVID with the shutdown of main streets everywhere and that sort of thing. But in the sort of very quick recovery that we had, a lot of businesses maybe couldn't get going in time to take advantage of low interest rates, or more problematic, they're generally funded at floating rate, right?
Yeah.
So now they'll probably enjoy a slightly lower interest rate from the banks, I would think, plus more of a pro-growth environment and maybe tax cuts that'll eventually let those business owners retain more of their wealth as time goes on as well. But obviously, I mentioned a lot of things that we're anticipating changing with the new administration. We don't know for sure, but I think that's an area to watch.
Yeah, not all out wait and see, but certainly waiting and monitoring to see how many of the campaign promises come to fruition as well. Right. Thomas, great to see you. Thanks so much for taking the time.
Likewise, thank you.
Absolutely. Coming up, everyone, investors poured over $1 trillion into ETFs in 2024. We're giving you sectors to watch in 2025. Plus, when you're planning your 2025 travel, one airline was above the rest when it comes to flights arriving on time. We'll tell you which one it was on the other side of this short break. Investors poured over $1 trillion into ETFs in 2024, with single stock ETFs notching the highest annual returns and crypto ETFs seeing the largest overall inflows. So what's in store for ETFs in the brand new year? For more, I want to bring in Vince LaRusso, who is the Claus Capital President and CEO, for this week's ETF report brought to you by Invesco QQQ. Great to have you here with us, Vince. First and foremost, as we think about some of the record inflows that we saw into ETFs in 2024, do you believe that that is expected to be the same type of spend or at least inflow propensity for 2025? And if not, where at least could we still see some signs of strength?
Yeah, hi, Brad. Thanks for having me. Look, I think the flows into ETFs are going to continue for several years at least into the future. And, and the reasons for that are not necessarily the investment strategies or the exposures that investors are seeking. It is the regulatory change that began in 2019 when the SEC came out with the ETF rules, 6C11. It began to open the door for active managers to take advantage of the ETF structure. And investors have taken notice, right? So ETFs for almost 3 decades have been really the domain of passive strategies. But when you open that window for active managers to move into that structure, the improvements, the chassis is just better. The tax efficiency, liquidity, and transparency of ETFs are ushering in a new level of interest and enthusiasm in ETFs, and the asset managers are responding, right? We're launching new ETFs, converting funds into ETFs, and Claus Capital was really at the forefront of that with a couple of ETFs that we listed on the New York Stock Exchange back in 2020 through ChangeBridge, now part of Claus Capital. So we've passed our 4-year milestone, and we see the growth happening, and we think we're really just in the early innings of that. Active strategies are still less than 10% share of all ETFs, and that number is going to go higher.
So we had a portfolio manager on earlier on in the show saying that some of the biggest opportunities that they were tracking existing in sectors such as financials, consumer staples, and producer durables. Does that necessarily transfer through, at least in terms of some of the biggest opportunities, into sectors that ETFs would see the most benefits from as well?
I think you could see that, Brad. So what investors are going to do is, at a broad level, look for a structure that best suits their needs. And sometimes those needs are the transparency, liquidity, tax efficiency, right? So that's the broad trend into ETFs. Within that, where are investors finding opportunity, or where do they see the most potential for growth? And they're gonna look for geographies, sectors, risk factors, whether that be small versus large or value growth. So those investor preferences or attributes are going to be garnering assets. It could be digital currencies, single stock exposure. They could be seeking yield. But I think it's just really important to zoom out and say, look, the broad trend into ETFs is more about the structural benefits. And then within that, where are investors gravitating? And we, as active managers at Claus Capital, we give ourselves a broad mandate. So we are able to look across geographies and sectors, and we're somewhat agnostic about a lot of the risk factors. We just want to find the specific companies that give our investors the best risk-adjusted return opportunities. We build a portfolio from those opportunities through fundamental research and analysis. But the broad observation, I think you're spot on. People are going to move into the sectors, risk factors, geographies that they want, and they're going to largely look to do that in the ETF structure, potentially first.
Which sectors do you believe those are?
Yeah, so right now we're probably, it's that time of year here as we kick off 2025 to feel a little bit contrarian, to try to look for areas that maybe have missed out on the broad lift in equities. We continue to be very bullish on equities, despite kind of 2 years of significant outperformance by the S&P 500 and kind of broad participation across a lot of sectors. We would probably begin to skew into some of the more value, parts of the equity landscape. So things like industrials and energy and consumer staples. We think the setup here is pretty good. If you continue to get a lift in equity exposure and a movement from maybe short duration money market type investments into the equity market, we think that trend will continue. So we're trying to find some of the laggers, and I think the opportunities in industrial, energy, and consumer staple are really interesting right here, especially on a risk-adjusted basis, because the valuations are much more compelling.
That considered, as you're thinking about industrials, and especially as we're kind of tracking across some of the sectors that were outperformers last year and where there could continue to be outperformance this year versus those that were underperformers, are you banking on a big bounce back on a sector basis this year?
Probably not. I think that goes back to our core investment process at Claus Capital, right? So we're more company specific. And by the way, we list all of our holdings on clousetfs.com, including a prospectus. So you can see that, we'll have less than 40 longs in the ETFs. at this moment in time, which is really an indication that we're not trying to make the broad call on a sector or a risk factor or even a geography. We're saying, look, within that, do we see opportunities? And the industrial opportunities to us look compelling, especially when you can get the tailwind of some of the onshoring trends that we think are very real, some of the build out in technology infrastructure, for example, and some of the data center needs. So, the question for us becomes, all right, we see this broad opportunity for equities. We think there's going to be a lift in equities as rates come down, as the economy still exhibits growth, as the labor market looks pretty strong, as the Fed becomes more accommodating, right? A lot of reasons to be in equities. Okay, within that, where do we see tailwinds? We think the e-infrastructure, onshoring, industrial, energy build out is very real. We need more energy supply to meet the demands associated with the build out of AI and data center needs. So then within that, we go another layer, right? What are the specific companies we like? An example like a Sterling Infrastructure, for example, which is a long position in both CBLS and CBSE, the two strategies that I manage. Well, that's a specific name where we've done the research, we trust the management team, we think they're exhibiting strong growth. They have this tailwind of industrial and e-infrastructure build out. And as an equity play, they generate free cash flow and they're exhibiting strong growth. So, that's kind of the process that we go through, Brad, to build a portfolio. I think broadly, if you see some sectors start to play a little bit of a catch-up trade, I think they could benefit from that as well. But look, technology is still the center of the investment universe. I mean, it's probably approaching or more than 40% of the S&P 500. We think that could continue to do well. But if we're trying to generate alpha for our investors and find individual opportunities that are, frankly, have an asymmetric risk-reward profile, they are pulling us more into some of those other sectors that I mentioned, industrials, energy, and consumer staples.
Vince, thanks so much for taking the time here with us today. Really appreciate it.
My pleasure.
Delta ranking among the most on-time airlines for 2024, despite a CrowdStrike tech outage that forced the airline to cancel thousands of flights in July of 2024. According to rankings released by Cirium, Delta was on time about 83% of the time. That earned it the top spot among North American carriers, with United and Alaska Airlines rounding out the top three. For the worldwide rankings, Delta secured the third spot behind Aeromexico and Saudi Airlines. Flights are considered on time if they arrive within 15 minutes of their scheduled time. Coming up, we've got your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We are 2 hours into the trading day, and it's time for Yahoo Finance's Market Minute. U.S. stocks moving higher to kick off the first trading day of the new year. Markets are eyeing a comeback after a year-end slide. Taking a look at crypto, Bitcoin rising above 96,000 to start the year. Crypto-related stocks like Coinbase and MicroStrategy also rising in tandem. And looking at shares of Vistra rising after the stock topped the leaderboard of the S&P 500 in 2024. This marks the first time since 2001 that a utility stock has managed to reach that status. And lastly, Jefferies turning bullish on Topgolf Callaway brands. Analysts upgraded it to a buy, noting that shares appear oversold. And that is your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, you can scan the QR code below to track the best and worst performing stocks of the session. We'll have more wealth when we come back.
It's the start of a new year, but the adoption of artificial intelligence is continuing full steam ahead. 46% of executives say that differentiating their organization and services is one of their top 3 objectives for investing in AI practices, according to a PwC survey. As more businesses strategize their vision on the use of artificial intelligence, the makeup of the workforce for companies is taking on new forms. Matt Wood, Global and U.S. Commercial Technology and Innovation Officer, joins us now with more. Great to have you here with us. So first and foremost, as we think about what you're hearing from companies and what this ultimately means in terms of their investment into AI means for their employees and for the labor force participants, how are you kind of gaming this out, and what are your biggest anticipations?
Yeah. Hey, Brad. Thanks for having me. Well, AI, as we see it today, is probably the single largest shift in how we're going to interact with data and information and each other, probably since the advent of the very, very earliest internet. And organizations that invested in the early internet 30 years ago went on to experience pretty tremendous growth in the intervening couple of decades. And it's my guess that organizations that are investing in generative AI today are going to experience the same, if not more, growth over the next 10, 20, 30 years going forwards. And so it's a very exciting time. And whilst there is some angst around what that means to the workforce, at least what we've seen at PwC is that organizations that are applying generative AI in a way which is responsible, it actually makes the intelligence and the expertise of their existing workforce stronger. It doesn't replace individuals, it augments their abilities and their expertise and allows them to deliver much higher leverage for the organization. So in a similar way as many organizations move from typewriters to computers, and that move made all of their staff more productive and happier and able to communicate at much higher scale, we'll see the similar shift as more organizations move from just using computers to using artificial intelligence to get their work done.
And so the word that we've heard tossed around the most, it seems, is agents. What is the reality that we can expect from agents as companies up their spends on how they deploy these agents? And then for those who are working with these agents, understanding what that does for productivity as well.
Sure. An agent is interesting because whilst a lot of us today are familiar with working with AI by asking a question or writing a prompt and getting the response, with an agent, you don't just ask a question, you set an objective. And the AI looks at that objective, it understands what it is that you're trying to do, and it will go off and form a strategy, a to-do list, if you like, in the background, and then it'll follow that to-do list to make sure that it finishes and meets your objective correctly. And as it learns more, as it goes through its process, it'll adjust its strategy and be more successful as a result. And what that means is it really opens the aperture for the types of problems and the types of ways that you can employ AI inside the enterprise. And so what that means for any organization is we'll spend a lot less time typing and a lot more time thinking. And that thinking time will be spent coordinating and interacting with individual or probably dozens of different agents, each of which are specialists in different domains to help us get our work done much more efficiently. And as a result, we'll get a lot more done. But also, my expectation is that we'll be able to spend more time thinking, connecting the dots, and that will allow us to deliver much higher value to the clients and our internal stakeholders.
What does that mean for headcount totals as we know them right now?
Well, it's super interesting. AI, like any technology, has some really counterintuitive effects. And in general, where you start to employ more automation inside an organization, you actually tend to see much higher return on investment. And as a result, you tend to invest more there because you get more returns. And what AI is doing is it's actually allowing you to get a better return on investment through increased productivity from one of your largest investments, which is your people, your headcount. And as a result, I expect there to be more investment in people. So counterintuitively, the more AI is used, the more valuable your people become. And as a result, the more people that you will hire. So there's a lot of talk today about shrinking workforces and using AI to drive efficiency that way. My guess is that the majority of the return on investment through AI will come from increased growth. And that growth will allow you to hire more people and more experts and use automation and AI and other technologies to be able to drive much higher return on that investment. So we're likely to end up with actually larger workforces than smaller ones.
So what are the skill sets, and thinking of employees here and how they can make sure that they're showing more immediate value to their employer as well, and hopefully that helps benefit if there's more compensatory measures that they're looking to achieve or performance measures that they're looking to achieve. What are the skill sets that are most valuable in the new AI agent era that employees can look to add on to their skill set?
Yeah, it's a really good question. I think the number one skill set is curiosity. AI allows us to explore new ideas in new ways and to augment and improve products and processes in new ways. And if you lean into your natural curiosity, number one, the AI will respond. They're very good at helping you brainstorm and fulfill that curiosity. And number two, as humans, it's a really powerful emotion to be able to satisfy our own curiosity. And so we tend to be much happier at work when we're doing that. And so honing that curiosity, staying open-minded, being humble in how you approach questions, asking open-ended questions, knowing how to form those questions so you can understand the responses, all of that allows us to explore and wander through a lot of the businesses and problems and customer engagements that we work with today. And as a result of using AI, all of those will become much, much stronger if we can embrace that curiosity.
Matt Wood, thanks so much for taking the time here today. A lot of interesting insights. We'll see how these play out in 2025.
Thanks, Brad.
Certainly. As we kick off the new year, many new investors want to jump into the market. However, the sheer volume or information that you find, especially on social media, can be overwhelming. On the latest episode of Stocks in Translation, Jared Blickry spoke with Jessica Inskip, who is the Options Plays Director of Education and Product, about the importance of financial literacy. Take a listen.
The way that I perceive financial literacy, first of all, there's always this talk of not being able to time the markets, but you can prepare for the markets. Meaning I can understand that the Fed is going to lower rates and when, because I understand how the Fed works, understand the impact on the yield curve and how that subsequently affects the consumer and then your investments. So that to me is the crux of financial literacy, is being prepared and being understand.
Having a plan.
Having a plan, but also understanding those steps to make that plan.
But this is tough because, I guess I'm only speaking for myself. They don't really teach you a lot of this in school.
I don't think you're speaking for yourself.
I'm trying not to make a broad generalization.
For the people. Yes.
I am the voice of the people speaking for the people. I think I took like a basic U.S. economy class in high school, and that was it. I don't even know if I learned a single thing about the stock market.
So that starts with the root of the problem. Now we go to the way that Gen Z likes to consume information. It's not Google. Back in my day, we Wikipedia'd or Googled, but it's
quaint.
Yes, right. It does. Nonetheless, it's via short form content and it's via TikTok. And if you think about the type of people who are producing content on TikTok, not all are bad, but the vast majority, due to the regulation that is around finance in general, have no experience and they're self-taught. Therefore, they don't know when interest rates
They end up
are going to
pumping the
come
wrong
down.
crypto.
Well, that, and even those that have good intentions, I feel like a lack of information could still lead to misinformation.
And you can find more episodes of Stocks in Translation on Yahoo Finance or watch on your favorite streaming service. When wealth returns, we're breaking down the investment basics for 2025. Stay tuned. We've got more to come. We're starting the year with a look at some of the most common ways to save for retirement and how you can maximize your money. Joining us for a look at IRAs, yes, hot topic, Sarah Brenner, Ed Slott & Company, Director of Retirement Education. Sarah, great to have you here. Happy New Year to you. Let's start with just the basics here. What are traditional and Roth IRAs, and how can taxpayers choose between them?
Well, the year 2024 is history, but the good news is there is still time to make an IRA contribution for 2024. The deadline for contributing is the tax filing deadline, April 15th, and you have a choice. You can make a traditional IRA contribution, or you can make a Roth IRA contribution, and the two types of IRAs are very different. One thing that people like about making a traditional IRA contribution is you get a tax break up front. A lot of people can deduct their traditional IRA contributions. So everyone likes that, getting a benefit right away. Roth IRAs work a little bit differently. With a Roth IRA, you don't get a tax deduction. So sometimes people think, well, why should I make a Roth contribution if I'm not getting an immediate tax break? The benefit is on the other end. With a Roth IRA, the benefit is going to be tax-free earnings and tax-free distributions. So very different strategies, traditional versus Roth.
And so, Sarah, where do the income limits apply?
It's interesting. There are no income limits for making traditional IRA contributions. Anybody with earned income can go ahead and make a traditional IRA contribution. Now, income can come into play, however, when it comes to deductibility if you participate in a plan at work. If you have a plan, like a 401k plan with your employer, then you are going to bump into some income limits. For 2024, if you are participating in a plan at work and you're married filing jointly, your ability to deduct your traditional IRA contribution is going to phase out when your income reaches $123,000. So that's important to keep in mind. Also, it's important to remember that if you don't participate in a plan, but you're married to someone who does, that also can affect your ability to deduct your traditional IRA contribution.
Right.
Roths work a little differently. With Roths, we do have income limits.
Got it. So you were mentioning planning and making sure that your plan at work transfers over. For those who do have a plan through their employer, how do you make sure that you can move your retirement money accordingly when you do change employers?
That's very important. We know that these days people change jobs frequently. So it's really important to give thought to preserving retirement savings when people change jobs. If you're leaving a job, what you can do is do a direct rollover from your employer plan right to an IRA. If you go to a traditional IRA, that will be a tax neutral transaction. So you'll have no tax consequences and you can keep your retirement savings going. Then you can contribute to the traditional IRA and add to your savings.
Certainly. Okay, so say you finally reach the date, your target date, and you've got the funds and you're ready to deduct now. What are the distribution limits that you should be thinking about and the age at which you should be thinking about that?
A couple things you're going to want to keep in mind here. You can access your IRA money at any time. However, if you're under 59 and a half and you take a distribution from your IRA, that's going to be considered an early distribution. And early distributions are subject to a 10% additional penalty. So that's on top of the taxes that you pay when you take the IRA distribution. Now, there's a list of exceptions to the 10% penalty. So sometimes an exception applies and you can get out of the penalty that way. But the majority of the time, you take a distribution under 59.5, you're going to be hit not only with taxes, but also with a penalty. Now, once you reach retirement age, Uncle Sam is going to insist that you take money from your IRA. The current age where distributions need to begin is age 73. It used to be 70 and a half, but then back in 2019, the Secure Act bumped it up to 72. Then we had the Secure 2.0 Act, and that pushed the age for RMDs to 73. So that's where we are right now. You got to start taking annual RMDs out of your traditional IRA once you reach 73. The nice thing about a Roth IRA is while you're alive, you never have to take money out.
All right, DJ Khaled would say major key alert there. Sarah, thanks so much. We appreciate it.
Thank you for having me. It's been a pleasure.
Absolutely. Well, Americans headed down south last year. That's according to U-Haul's Growth Index, which tracks one-way moves by U-Haul customers, and it found families are overwhelmingly migrating to the southeast and southwest states, at least during the past year. South Carolina, South Kakalaki, they topped the list, followed by Texas, North Kakalaki in North Carolina, and Florida. In a press release, U-Haul pointed to the cost of living, job opportunities, and quality of life as motivators for movers. States across the Northeast saw the biggest number of folks leave, but the biggest net loss state was actually California, coming in last for the 5th consecutive year. And on the same thread, mortgage rates, they stayed stubbornly high in 2024, but what might the new year bring here? We heard from a host of experts in the last few weeks talk about their outlook for the housing market in 2025, and here are some of the best bites.
So I don't think we're going to see mortgage rates move all the way back down to where they were over the last few years. Our expectation is that we'll see mortgage rates edge down to 6.2% by the end of 2025, and that'll mean an average mortgage rate of 6.3% across the year, because we expect home prices to continue to climb, but not as quickly as we saw in 2024. That means that those falling mortgage rates will basically help offset that gain in home prices, and monthly payments will be relatively flat. If we combine that with a healthy economic backdrop, which we expect, it means incomes go up, and we should see affordability improve very modestly for home shoppers in 2025. I still expect spring to be the peak season, but I do think as mortgage rates come down throughout the course of 2025, then we're likely to see some improved conditions in the second half of the year. But again, spring and summer is still going to be that peak home buying and selling season.
So we think the market will be a bit better next year, but not a whole lot given that mortgage rates still remain quite high.
What's the magic number that you're anticipating on the mortgage rate front where we could potentially see some averaging out?
Well, prices are already reflective of current mortgage rates, so we're going to see sales even with these high mortgage rates. If mortgage rates were to come down, say below 6.5%, something closer to the 5 range, then I think we would see a large burst in demand, more bidding wars, more price growth than even what we're anticipating right now.
Certainly, and taking a look at some of the predictions here as well, even as we're showing that 6.8% rate on the screen for our viewers here, you're also anticipating that home prices will still rise 4% in 2025. Why is that?
Well, a lot of people have been delaying buying a home, thinking that mortgage rates were going to fall. And now that it looks like mortgage rates are going to stay pretty much where they are, there's no reason to wait anymore. So even though rates haven't come down, we do expect more buyers to come back. Also, the economy is growing, and some people are really ready to buy a home and can pay in cash to avoid those high interest rates. So I think demand is going to be stronger.
Given the higher mortgage rate environment, Zillow does expect probably fewer new listings from existing owners than we did just a couple months ago moving in to that next year. That said, we still forecast a steady improvement. That's going to be particularly true with more new listings come in the lower half of the US. This past year, that was the case in Florida and Texas, where we saw buyers markets and rising inventory. We expect that to now start moving into the Southwest. For similar reasons that you think of, when I think of the lower half of the US, those are owners that are less locked into their mortgage. So they're less locked in when a major life event happens, like say they're ready to retire, move down, move up, more kids. They're more able to do so because that housing market is actually still functioning and moving with available listings. That will be more the case moving forward, I think, in more areas as inventories start to rise and buyers experience affordability challenges. So not everybody can move forward, right? Over time, I think we're going to have a softer housing market in 2025, but steadily going towards normal.
Well, I think we're going to see that certainly as we move into 2025 and into 2026. With the persistent lack of lots, or at least I'll say affordable lots, really that's the lifeblood of the industry is land. You add on to labor and of course regulations and NIMBYism, and you have the makings for a difficult housing market moving forward. But I think if we look at ways that we can release those lots, I think that is the one thing I would ask local governments to do is we get ready for what I think is going to be a golden age of housing production over the next 4 or 5 years. We really need to get those pieces of land in the pipeline now, and we need to get them in there affordably so that we can meet demand in the future.
The home sales have been rising recent months after being stagnant in the early part of the year, and the reasoning is very simple. We have more inventory. So more inventory is bringing out more buyers. We know that the mortgage rate is not fully behaving as the Federal Reserve has been cutting rates, mortgage rates stubbornly refusing to decline, but the more inventory, more choices for consumers are bringing buyers back into the market. That's why it is critical that the builders ramp up production in the upcoming years. So I do believe that the builders need to produce more and will produce more, thereby providing that golden years upcoming.
That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. Stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern Time.